Good afternoon, everyone. Am I audible to you? You can reply either through you, unmute and reply, or you can answer in chat box. Yes, so I have received the quick answer. So thank you very much. Wish you warm welcome to our day two of NISM Common Derivative Examination Certification, which is the mandatory for the SIF product, which is expected to come in next 1 or 2 months. Yesterday we have learned about the basics of derivative market. We thoroughly learned about the concepts and solve the pre-training test for the equity derivative, and as well as the currency derivative pre-training and post-training test. Okay, so let uh, start with the quick query. In case if you have any query, either you can write it in a chat box, or you can unmute and ask the question. So first 2-3 minutes we'll solve the query, and then we'll do quick revision, okay, for benefit of all. If no query, you can write your top one key learning. So what you have learned in last session 4 hour we discussed. So what is your one top key learning? Okay, that you can write in a chat box. Okay, score is improved from 2 to 7 in currency test. Good, very good, congratulations. So it shows that you have attentively learned the currency derivative subject. Okay. So good, very good. Yesterday it was more about the basics. We'll quickly do a quick revision. So initially we discussed the why the exam. Okay, then key benefit of having the this certification to you. How to pass the exam at first attempt. So we discuss in detail. We quickly also discuss about the what are the features of the upcoming SI product. Okay, more clarity will come once product is introduced by the AMC. Assessment structure we discuss, and we broadly divided the our study plan into 5 broad modules. Okay, so first, yesterday we covered the basics, which weightage is 15%. Today we are going to discuss future and forward contract. Okay, we'll start with the equity, and then we'll discuss the quick differences for the currency and the fixed interest. Option tomorrow we'll discuss again 20% weightage strategies, trading strategy, 15% weightage operational and regulatory aspect, 30% weightage. So it is very important that you need to attend the 20 hours training, as well as based on your background you may require 40 to 50 hours of preparation. So minimum you can consider 40 hours of preparation to pass the examination. So this is the basic we discuss about the products derivative. So broadly divided into 4 category: products, forward, futures, option, and swaps. Today we are going to discuss in detail. Okay, so I'm not revisiting. Market participant we can broadly divide into 3 categories: speculator, hedgers, and arbitragers. 2 types of derivative market where derivative trade can happen. One is the over the counter, and second is the exchange traded derivatives. and what are the risk in the derivative product. So it includes the entire the derivative markets, counterparty risk, price risk, liquidity risk, legal or regulatory risk, operational risk. So yesterday we completed the basic concept. Do we get the recording for the revision? Yes, we will upload this video by next week in partner desk. So on a resource center, we'll share it, and we'll share the path also. Okay, so it is available from the next week. Any question, queries, anyone, either one can write in a chat box or one can unmute and ask question. So hopefully right now there is no query. So let's move into the R chapter 2. Okay. In chapter 2 today, so this is a self-study chapter. So I'm not going right now for training. So we are starting with the chapter 3, which is the uh, forwards and future. Okay, so in this chapter, we'll learn in more detail about the forwards and future contract. What are the key differences between forward and future contract, terminologies related to the future contract, payoff for the future contract, okay, pricing of the future contract, and application of a future contract by traders, hedgers, and arbitrager. So as we know, when we are starting a new subject, I have missed yesterday. Please brief yesterday in 20 points. Sorry, it is not possible right now. Okay, you can start with the current topic, and you can go through the PPT at your convenience. PPT I'll share with you. Okay, end of the session. So you can revisit with help of the PPT yesterday's session, as well as you can go through the video when we publish the video on partner desk. So hopefully you will understand, because the otherwise it will waste of time for the other participant, those who attend the yesterday full session. Okay, so we are starting with the pre-training test. So I am sharing you a link. We will share. We have already given to the. This is the second batch. First batch was in Hindi. We have given to the IT team, so they will upload by end of this week. And this training English we are doing right now. This training video will upload once training is completed next week. Okay. So till time you focus on the learning. Okay. So I am sharing you a pre-training test. Okay, so once you open this pre-training test, okay, you will come to know SI pre-training test day 2 equity chapter 3. I request everyone, okay, read the each question twice, okay, and if it is a calculation question based on the current understanding, you can solve this question. If it is a theory question, you can read the option and solve as per your understanding. So time is 10 minutes. Okay, so it is a 14:10. So you have a time till 14:20. So right now everyone is attending the pre-training test. So this is a link I have shared. Okay. So please click on the link, and based on the current understanding, you can attend this pre-training test till 2:20. Okay, last 5 minutes to attend. Okay, last 2 minutes. No problem, Nilesh bhai. Now you need to attend next 3 hours this futures and forward session. And when we conduct the another post-training test, okay, I'm sure that you will be able to attend with the uh, right knowledge and skill set. Okay, so I request you can submit the test. So we are moving forward with the our training. So as we decided in futures and forward, okay. So today we are focused on the forwards and futures in more detail. Yesterday we have introduced the concept. What is the forward? What is the future? But we'll take it forward more in detail. Okay, we'll start with the equity, and then we will also discuss the differences, which is reference to the examination, currency, and the interest rate derivatives, interest rate uh, forwards and the future. Okay, so I'm reading and then I'll explain if required. A forward contract is an agreement made directly between the two parties to buy or sell an asset on a specific date. Okay. So a forward contract is an agreement made directly between the two parties to buy or sell an asset on specific date in the future at the term decided today. So yesterday we took an example of the. I am right now also doing a quick revision because yesterday we discussed. I am doing revision for the benefit in case someone is not attended. Okay, so forward contract is like a customized contract. Okay, bilateral contract. It is between two parties. Okay, so yesterday we took a example of the farmer and the. So there is a wheat farmer is there. Okay, and wheat farmer and the company that use the convert the wheat into the flour and selling the wheat flour. So wheat farmer is worried about the price drop when cash is when crop is ready. Okay, because we know that it requires 3-4 months. Okay, after the all this farming, the crop is ready. Okay, so he is worried about the price drop in the future when crop is ready. The company is worried about the price rise. Okay, so what they can do, these two people, okay, they have a different and opposite risk. They can come together and make an agreement where wheat farmer, okay, farmer and the company make an agreement, okay, where they call it forward contract technically. So agreement says that wheat farmer sell and company will buy. So let's say 10,000 kg wheat particular quality, okay, that is decided today. Price is decided today, and the delivery will happen after, let's say, 3 months. So this is known as a forward contract where quality, quantity, price, everything is decided today, but delivery is happening in future. Okay, maybe after 1 month, 3 months, maybe 6 months. Okay, based on the requirement of the party. Okay, so that is the reason this is called the forward contract. Okay, so let me just again go back, and in case if anyone has a query, they can either put it in a chat box, or maybe ask in the chat box, or unmute and ask the question. So forwards are widely used in commodities, foreign exchange, equity, and interest rate market. Essential features of the forwards are: it is a contract between two parties, as we discussed, bilateral contract, example between wheat farmer and the second company. All of the contract, like price, quantity, quality of underlying delivery terms like place, settlement procedure, etc., are fixed today when we enter the contract. So this is the about the forward contract. Now, what are the major limitations of the forward contract? Okay, so major limitation is first is the counterparty risk. Okay, so counterparty risk is the risk of economic loss from the failure of counterparty to fulfill the contractual obligation. Okay, so here in this example, there could be chance that wheat farmer may not able to supply the required quantity, required quality. Okay, or maybe partly or fully. Same time, if company also may like to renegotiate the price if prices drop in the market. Okay, so they are unwilling to pay the decided price. Let's say price is decided 50 rupees, and at a time of season price is 40 rupees. So either party, okay, may think, okay, why I should pay the higher price. Okay, this is the seller buyer will say, and try to renegotiate or maybe default the contract. So first and foremost risk in the forward contract is the counterparty risk. Okay, and second risk is the liquidity risk. So ability of the market participant to buy or sell desired quantity of underlying assets. Okay, so once contract entered, okay, there could be a difficult to exit before the maturity. Okay, forwards are not listed or traded on exchange, which makes it difficult for other market participants to easily access the contract. So here this is a bilateral contract. Okay, so there is no trading between the participant. There is no trading. Okay, between the there is no listed contract, so it is quite difficult for other participant like speculator or maybe hedgers, or apart from hedger, speculator, or the arbitrager may not able to participate in this contract. Okay, in addition to the illiquidity, so these are two important risks. In addition to the illiquidity and counterparty risk, there are several issues like lack of transparency, settlement complications, as it is done directly between the contracting parties. So these are the other risks. So forward contract, as we discussed yesterday, it was started 400 years before, okay, in Chicago, and over a period of time that moved to the forward to the future contract, because the limitations of the forward contract is solved when we enter into the future contract. So let's quickly get into the what is future contract. Again, it is a revision only. Okay, future contracts were created to overcome the limitations of the forward contract. So this is the most important point. And future contract is an agreement made through an organized exchange to buy or sell fixed amount of commodity or financial asset on future date as agreed price. So here advantage is that wheat farmer, okay, and second is the company. Okay, this is a seller of wheat, and this is the wheat buyer example. So here it is in between, there is a intermediary is there, and this intermediary is exchange. Okay, and that exchange will ensure the guarantee of settlement. Okay, so this is the biggest advantage. Future contract is contract between future contract is an agreement made through an organized exchange to buy or sell a fixed amount of commodity or a financial asset on a future date at agreed price. So it could be cash settled also. We'll discuss during the day in training. Okay, it could be a cash settled or it is a delivery base also, where the seller will deliver the wheat to the buyer. Okay, or it could be cash settled also. So what are the key features of the future contract? So futures are standardized forward contract that are traded on the exchange. The clearing corporation associated with the exchange guarantees the settlement of this trade. Trader who buys the future contract takes the long position, and the one who sells the future take the short position. So here there is a terminal called, if someone is sell, okay, it is called short position, and someone buy the future, it is called the long. So yesterday also we discussed long means buy and short means sell. Features of the future contracts: contract between two parties through the exchange. We discuss centralized trading platform, which is an exchange. Price discovery through free interaction between the buyers and sellers. Margins payable by the both parties. So here maybe as per the decision of the exchange, maybe 5% or 10% of the contract value is margin is paid to ensure that there is a no default. Okay, quality decided today and the quantity also decided today. Now let me discuss last slide and then I'll take it your questions if any. So what are the key limitations of the future contracts? So definitely exchange introduce the different maturity contract, maybe 1 month, 2 month, 3 months, 6 months. Okay, so there is a limited option. So it is a standardization. So no customization is possible. Okay. Limited underlying set. Okay. So where which is decided by the exchange. Lack of flexibility in contract design. So once contract is decided by the exchange, so buyer and seller has to use this contract only. They cannot customize the contract. Increase the administrative cost on account of MTM settlement. So here it is a daily mark to market settlement is required. So it will also add the cost. So here we had quickly revisited the important concepts of the future, important concepts or terminology of the forward contract, limitations of forward contract, future contracts, key features of the future contracts, as well as the few limitations of the future contracts. So if you have any query, okay, you can write it in chat box, or if you wish, you can unmute and also ask the question. If no question, you can write no question. So at least I can understand you are active listener.
Sir.
Yes, please.
M2M is the daily basis margin difference pay.
Yes, it is a daily basis.
Okay, it is customized 5% or 10%.
Yes, whatever the decided by the exchange.
If the 10% margin and margin call difference between 8%, I can pay 8%.
No, we'll discuss in detail. Let's say there is a contract size is 10 lakh rupees. Okay, and exchange requirement is, let's say, 10%. So you first deposit the initial margin of 1 lakh rupees for 10 lakh rupees contract, whether you are a buyer or seller. Now, end of the day, okay, price is different. Okay, mark to market. Now,
price fall to 92,000 or.
Okay, so now let's say the example 10 lakh contract in simplicity, it becomes a 10 lakh 10,000 example. So, buyer will get the 10,000 credited in the account and seller will have to pay that margin. Okay, so it is ensure there is no counterparty risk when contract mature.
If difference arise, daily basis to pay and credit and debit. Daily basis.
Yes.
Okay.
In which exchange foreign exchange is traded? So it is here we are learning equity, or you can say interest rate, and third is the currency. All three are considered are the financial assets. So it is traded on the example NSE or BSE, those who have introduced the contract. Okay, example equity is very popular. Interest rate and currency is also there, but it is mainly used by the institutional investor. Okay, so let move ahead. I'll just quickly just give me 1 second. I'll show you one quick key difference between the, so summarize the key differences. And as yesterday also I suggested, let me just give you once again to the all participant. Okay. Right now we are not discussing the foreign currency. Okay, so please keep your discussion limited to what we are learning. I understand ki if you ask some question which is expected to discuss later, okay, chances that you will miss the current learning. So keep your attention completely in a learning only. Otherwise, if you're thinking too many things at a time of learning, okay, you will miss the current thing, okay, current learning, and then again will find difficult to connect ourselves. So yes, yesterday I shared at the beginning of the my training, I am sharing that in online training I don't have a control about the participant. So it is your duty to ensure that. Just give me 1 second. I'm giving input. Okay, so it is your duty to ensure that you basically do not do multitasking. You attend attentively. Okay. Second is very important that you ensure that you to have a engaging and interesting learning. You can also note down some important concept, okay, in your pen paper. So more you note down, so more clarity will emerge. Okay, and at least you will avoid the multitasking because you engage yourself in learning only. Okay, and definitely at a regular interval will take your relevant queries. Okay, and in case of if there is some other queries there, we can discuss even post session also. You can send me on a WhatsApp or email that I have already shared yesterday, and I'll share it with you today also. Okay, so I'll just like to show there is a one handwritten slide long back I have prepared when I was preparing for the CFA. Okay, so quickly I'll share you the key difference future contract versus forward contract. So I request keep your mic mute right now. Future contract versus forward contract. So future, as we discussed, it is an exchange traded and it is the OTC contract. So it is the OTC means again there is a electronic or physical platform is there. On that electronic or physical platform, the buyer and seller can meet and basically create a bilateral contract. Here it is a daily mark to market. Here there is no mark to market. Only the expiry settlement happen. Margin is required. Here no margin is required. Standardization in terms of maturity, dates, settlement procedure, commodity, etc. Okay, it is a customized. Here it is a clearing house is there. Here is counterparty settlement. Action act as a counterparty. Okay. In case of default, so there is no counterparty risk is there, but here it is a counterparty risk is there. Daily repricing mark to market. So when new price will come, end of the day, it will be base price, okay, or revised price. Here no repricing. Heavily regulated, less regulated. Here we call futures. Here we call forward swaps. More transparent, less transparent, and more less expenses and more expenses. definitely we'll discuss future contract can be a cash settled also or delivery also. Okay, forward contract also can be a cash settled or delivery based contract. Okay, someone asked for our previous slide. Okay, tell me what is the question. You can unmute and ask the question. Okay, so there is no question. I'll move ahead. Okay, so we are now, once we have understood the uh, forward and future contract features, you can say benefit limitations. Now we are moving with the future contract. Now please understand, forward contracts are customized contract. Okay, so it is between the two parties, so there is no standardization is there, so it is not part of the syllabus. So here we have a future contract for equity, fixed income, and third is the currency. We'll learn one by one what is right now in our country. Okay, so contract specification for future contract. So quotes given on NSE website. I'm just going with the book data. Okay, NISM book data. So may be different from the current, but concept remain the same. So what NSE website says, NSE Nifty future as on May 10th, 2023, instrument type is index future, underlying asset is Nifty 50, expiry date is May 25, 2023. This was the open price, high price, low price, closing price. Okay, number of contract traded, turnover, underlying price. So one by one, we'll try to learn in detail, and then we'll do a calculation also, reference to examination. Contract specification of the future contract. Underlying instrument is Nifty 50 index. So when I say it is a Nifty 50 future contract, so this is a future contract, and we know that when derivative is there, there is a contract is based on the underlying asset. So your underlying asset is the your spot. Okay, Nifty 50 index. Yes,
Sir,
tell me.
first page में
बोले
back page. Uh, turnover in lakhs. It is how calculate 870891.
हम राइट टाइम पे डिस्कस करेंगे। ये जो डेटा मैंने सिर्फ टैक्स से लिया है, ठीक है ना, तो उस दिन का डेटा होगा एनएससी का। तो अभी मैं उसके ऊपर डिस्कस नहीं करता हूँ। आई विल डिस्कस एट राइट टाइम हाउ टू कैलकुलेट दी volume and the open interest, that will discuss reference to the examination.
Okay.
So as I discussed that there is an underlying instrument called there is a Nifty 50 future contract. So what is underlying instrument? Nifty 50 index. Okay, underlying price value of Nifty index as on May 2023 is 18,315. So contract multiplier or contract size. So Nifty future contract can be calculated by multiplying lot size, closing price. Okay, so contract multiplier is 50. Okay, right now it is 75. In exam, you will get the multiplier when you have to calculate. So data will be given to the in the calculation question. So what is the contract size is? Okay, right now one Nifty index is 1834. 18,345.50 into 50. So contract size is 9,17,275. Contract cycle. It is a period over the contract trade month, near month. So you have to remember that Nifty NSE offers three monthly contract. One is the near month, okay, which is a expiry same month, May month. Second is the next month, or it is also called mid month, which will expire in June 2023, and third is the far month, July 23. Okay. NSE and BSE offer trading on monthly as well as weekly future contract. Okay, so from exam point, what is most important for you? The most important is three contract cycle, and key contract cycle which is the, suppose today we are in 11th June example. So there is a one contract that will expire in June, okay, then July and August. So this contract known as a, okay, near month contract. This is the mid or next month, and third is the far month contract. So there are only three popular contracts are there. Definitely, as mentioned, it is a weekly option is also available. Now, one by one, we are learning the important point reference to the examination. Expiration day. This is the day which derivative contract cease to exist. Okay, so reference to this example. Okay, this contract expires on 25 May 2023. Okay, so what will on expiry day of 25 May 2023, this is the day which the derivative contract ceased to exist. It is the last trading day of the contract. On expiry date, all contracts are compulsory settled. Nifty and Bank Nifty future contracts and the stock future contract listed on NSE expire on last Thursday of the respective month. So from exam information question may come, as I said, 15% question may come on the information. So you have to remember NSE, okay, weekly and monthly contract expire on a last Thursday. If Thursday is holiday, then it is a expire on the previous day. Tick size, it is the minimum move allowed in the price quotation. Okay, exchange decide tick sizes on traded contract. Tick size also known as a minimum bid offer spread. Okay, as per the contract specification, tick size Nifty future is 5 paisa. Okay, so example, if I take this example, okay, so you can see that when open, it was open 18,325, then high price was 50. So it is moving in a multiple of 5 paisa. Okay, 5 paisa means 0.05 INR example. Then low price was 18 to 55.55 and closing is 18,345.50. So it is a minimum price moved in the quotation. Okay, bid price is the price buyer is willing to pay, and ask price is the price at which seller is willing to sell. So it is a very important discussion. Yesterday also we did. I'll quickly, for benefit of everyone, I'll do it. Example, current price is 150.25 and 25,150.75 example. So this is known as a bid price and this is known as a offer price. Okay. So if you want to buy, okay, then you will get at a offer price. And if you want to sell, okay, you will sell at 25,150.25. Okay, so this is the known as a bid offer, and difference between that known as a bid offer spread. Here it is a bid offer spread is 0.25. Again, when we continue the journey, I have a question regarding the MTM settlement, whether you permit in the break. So we have not reached to the MTM settlement. Na? Okay, you can ask the question. Okay, let's see if it is relevant, we'll discuss. You can unmute and ask the question.
Sir,
actually,
am I audible, sir?
Yes, you are audible.
Sir, futures is ultimately a contract. Means for every buyer, there must be a seller. And for every seller, there must be a buyer. Okay. Suppose if I'm opening a position and I went into a sell position, and at the end of the day, I'm not able to meet my margins. suppose MTM is too much and I am not able to pay, the exchange will square off the trade.
So what is your question? Tell me. You are giving a information or you are asking a question?
The exchange will square it off. Then who will be the buyer in that case, sir? If a seller cannot meet the margin obligation.
It is not your headache. That's the reason action is there, na? So when we learn the yesterday also, okay. So or today, if I give it is the yesterday also we discuss, okay. So it is the counterparty is exchange, okay. So there is a here. If I say that key, this is a buyer and this is the exchange, okay.
Yeah.
Indirectly, the contract is your contract with the clearing corporation, okay, within the specific exchange, okay. So,
right.
Seller, the clearing corporation is buyer, and for buyers, the clearing corporation is seller. So that's the reason they are taking a margin from you. That's why they're taking a margin from brokers. Okay, they have a settlement. In coming syllabus, we'll learn about the settlement guarantee fund. So they have everything. Okay, so that's the reason. Okay, it is a question which is we are going to discuss in the upcoming syllabus. Okay.
Okay, sir. Okay, sir. Thank you.
There is no need to worry.
Yeah.
So my humble request that if question is specific from the what we have learned, and if you are not getting the something in the specific what we have discussed, then it is a relevant question. Otherwise, you have some knowledge, and based on that knowledge, if you ask question, maybe it may cover in the coming syllabus, okay, or we can discuss also one-to-one if required. So contract
size. सर ये टिक साइज जो आपने बताया दैट इज डिफरेंट कि हर एक स्टॉक की डिफरेंट होती है, हर एक स्टॉक में भी 5 पैसा ही रहता है, जैसे निफ्टी का 5 पैसा ऐसे स्टॉक में भी सेम रहेगा.
Right now we are discussing about Nifty 50 contract. Okay, so when we discuss the stock specific, we will discuss okay, what is the tick size for the stock specific. Okay.
Okay.
So right now you need to understand the concept first, as well as some information reference to the Nifty 50 future contract. Okay, so next is the daily settlement price. What is the daily settlement price? So daily settlement procedure for open position in equity index and stock future contracts, which is calculated by the exchange on basis of last half an hour weighted average price of the future contract. So very important from exam point of view, this kind of question may come. The closing price for daily settlement is the last closing price, spot price, okay, or it is a last half an hour weighted average price of the future contract. Okay, so important final settlement. The final settlement price is closing price of the relevant underlying index or stock in the cash segment on the last trading day of the future contract. So final settlement price is always spot price. That you have to remember. Okay, final settlement price is always spot price, or you can say closing price of the underlying index here, underlying index, which is the Nifty 50. Trading hours, trading during the normal market hours 9:15 to 3:30 from Monday to Friday. Any question here, understanding what we have learned reference to the PPT? Bid offer spread we discussed yesterday in detail. Okay, so I request you can go through the initial PPT that we'll share with you. Okay, and later on the video also. So bid offer spread is basically as we discussed that key, it is the quote by the market maker. Okay, so suppose you want to buy the future example, then you have to buy the future, okay, at the offer price, and if you want to sell the contract, okay, or you want to sell a stock, example, even bid offer spread is for the not only for the future, but it is into every into cash market, equity, stock also. There are two prices there: buy price and sell price. Okay, so when you want to sell that stock, example, you have to sell it at lower price. So you understand simplicity. Okay, if you want to buy, you need to pay higher price out of two price, and if you want to sell as a user or as a investor, you have to pay. You will get the lower price. Okay, and difference is the bid offer spread. Okay, so we are moving ahead. So from here, it is a more technical discussion. So keep your attention here. So important terminology associated with the future. So what is the basis? It is a different. Vijayji, please keep your mute. So basis is a difference between the. विजय जी आप म्यूट कर दीजिए, अदरवाइज मुझे सबको म्यूट करना पड़ेगा. आई डोंट वांट कि मैं सबको म्यूट करूं. So basis is a difference between the spot and the future price. Okay, spot means current market price. Spot price is known as a current market price. Okay, and future price is different from the current market price. Okay, so difference between the spot price and future price is known as a basis. Okay, suppose if I say that today Nifty is 55,000, 25,150 example. Okay, today Nifty is 25,000 in spot market and 25,170 rupees in the future. June month future price is 25,170. So when I say difference, spot minus future, okay, difference is minus 20. So here we call it basis is the negative 20. So interpretation of the basis, negative basis, okay, when future price is higher than the spot price. In this example, future price is 25,170 and the current market price of Nifty index is 25,120 for the June 11th. Okay, so it is the negative basis. Positive basis, opposite. Okay, where spot price is higher than the future price. Now, what is the most important? Basis can shift negative or positive during the life of the contract due to the price movement. At maturity, basis becomes zero. Okay, and because of the final settlement is closing at the spot price. So on a maturity, the spot price will convert to the future price. Okay, so basis become a zero. Any question? There is one. Premium. What is premium? Any question in this slide? If yes, you can write it in a chat box. If no, you can write no.
Sir.
So it will. Yes, tell me.
तो मेरा सवाल ये है, निगेटिव बाय बेसिस और पॉजिटिव बेसिस का कोई इंटरप्रिटेशन होता है क्या, कि जैसे नेगेटिव बेसिस है तो ये अच्छा है मार्केट के लिए, या पॉजिटिव बेसिस अच्छा है, ऐसा कुछ है क्या इंटरप्रिटेशन इसका?
ये हम आगे की स्लाइड में देखने वाले हैं. वी आर गोइंग टू लर्न इन अपकमिंग स्लाइड के why there is a difference between the future price and current market price. Okay, so that is going to we are learning in the next slide. But here from the thought process perspective, okay, if question is asked what is basis, so you must aware, okay, basis is a spot price minus future price. It is difference between the spot price and the future price. Okay. How I can calculate the negative basis? Negative basis, when the future price is higher than the spot price, it is a negative basis. And last, I say that key on maturity basis become a zero, because current market price is converged to the future price on the maturity on 25th June or maybe expiry of the contract. Your question will discuss in the coming slides. So this is the answer of your question, okay, why there is a difference. Okay, why there is a difference between the current market price and the future contract price. So difference reason is the cost of carry. Okay, so let's understand the difference definition of the cost of carry. So definition, relationship between the future and the spot price. Commodity, what is the cost of carry? So what are the cost? Storage cost, financing cost. Okay, we need to borrow money to buy the commodity, example, less any income on the asset. In equity derivative, what is the cost of carry? Okay, so here it is a cost is interest paid to finance the position and less if any dividend received. Okay, so we can say then cost of carry, simplify. Okay, it is a spot price plus, okay, you can future price is equal to spot price plus cost of carry, and cost of carry is in equity derivative, which is a finance cost. Okay, cost of borrowing, and if any dividend received, income is if any dividend received. So that's the reason there is a difference in the price. We'll take an example also. So right now, let's take one simple example for calculating the cost of carry. ABC Limited break-even future price. How we can calculate the future price of the theoretical future price on a first day? Theoretical future price on the first day. Okay, for 1 year expiry contract. Cash price is 100 rupees. Financing cost, okay, for borrow 100 rupees is example, let's say 6%. Now this borrowing cost can vary from individual to individual. Okay, so you can consider your investor can consider their own cost also. Dividend expectation is 2 rupees from the in next 1 year. So net cost of carry is interest you need to pay 6 rupees, and dividend you will expected to receive 2 rupees. So it is a 4 rupees. So break-even future price is for 1 year contract is 104. As I said, cost of carry may vary among the participants. Someone may have a higher interest cost also. Someone may have a lower interest cost. So average then price will come. Okay, so now there is more clarity about the cost of carry. So we'll move to the next important discussion, initial margin in the future contract. Deposit required in the margin account when entering the future contract. Example, date May 10, 23. Position, someone want to long the Nifty future. Okay, May expiry at 18,275. Long means buy. Bullish. That a trader is bullish about the Nifty index and he expects that in a next 15-20 days, okay, till expiry, Nifty will give the positive return. Lot size is 50, contract value is 18,075 into 50, 9,13,750, and exchange has decided the 10% initial margin. Okay, then initial margin amount is 91,375. So how much buyer and seller both have to pay in future contract? Okay, someone want to long or short 91,375 rupees that deposit to the exchange. Key point, both buyers and seller post the initial margin. The margin requirement can vary with the underlying asset volatility. More volatile assets attract the higher margin. Exchange may charge maybe 50% or up to 100% margin also if asset volatility is very high. Okay. Now we are coming to the one question which was asked, MTM. What is the marking to market? And we'll take an example also. daily settlement of profit and losses on future contract. Okay, now you can keep in mind that we have entered. Okay, you have entered into the long Nifty contract, Nifty May contract. Okay, which is a contract size is contract value is 9,13,000. You paid the 91,370 is the initial margin, and your purchase price of Nifty is 18,275. Now, what will happen after one day? Okay, based on the price volatility of Nifty index, Nifty future. Okay, there is a MTM profit or MTM loss. So daily settlement of profit and losses on the future contract, even though contracts mature after several months or several days, MTM margin are collected from loss-making positions and credited to the gainer each day. Position reset to the closing position at the end of the each day. MTM minimize the risk, regularly settling the gain and losses. Why we do a MTM? Very important, to minimize the risk by regularly settling the gain and losses. So there is a lower chances of the default. There was a one question, okay, when someone could not pay the MTM and it is a basically squared off. So at the time there is an initial margin was there. So initial margin is sufficient to cover the losses. Okay, initial margin we'll discuss. It is sufficient to have a one-day losses. So in that condition, there is no need to worry for the counterparty. And again, exchange is there to ensure the settlement of the contract. So again, let me go to the example. Date May 10, 2023. Entry price is 18,275. Nifty future. Someone has done a long example. Initial margin paid 91,375. Day end price is 18,345. Okay. So it is a day gain 70.50. So buyer, someone who is a long future, so MTM profit 70.50 into lot size 3,525 credited, and seller MTM loss, this amount will be debited. And now for next day, new base price will be 18,345. Okay, this is debited and credited over and above keeping the 10% margin. So margin is for the initial margin, and we'll discuss also here settlement is T plus 1. Any question if you have, you can.
Yeah, so when we buy, I understand the cost works out to be 91,375, which is 10% of the overall cost. What about for the seller? Seller also pay the same amount, 91,375, or it differs?
Yes, same.
Okay.
In future contract, both buyer and seller has a equal margin decided by the exchange. If it is a 10%, both party will pay the 10%. In case of dividend, we'll discuss. Okay, we discuss also. We'll discuss. Okay, your question is discuss dividend. Okay, so a very important discussion how it is the MTM marking to market, okay, and how the profit or loss is credited or debited to the parties. Now we are moving towards the next level, open interest and volume traded.
Sir,
Okay.
1 minute.
Yes.
Hello.
Fully.
You mentioned it's a T plus 1, but you explained that it's the same day it's getting settled at the end of the day.
No, as I said that settlement will T plus 1, and so next day this debit credit will happen. Na?
So only for the accounting purpose, it will be reflected in the account next day.
No, not reflected accounting. If you are in profit, you will get that amount credited into your broking account. Okay, and if you are at loss, that amount will be debited from your broking account by the exchange. So you need to keep some money also in broking account. Now we have a broking account. Okay, let's say prudent. Okay, so you have paid the initial margin, which is moved to the exchange. Now, over and above, if you are a trader and you also keep some 50,000, 25,000, okay, so any NTM losses is there, then it must be automatically debited also. Right now, nobody is waiting for a check or basically to call you to settle the your dues. If you don't settle, then position will be square off.
Okay, thank you.
So now again, very important topic reference to the sir, what will be margin money required for next day? Next day, good question. Please understand, margin money is fixed 10% is based on the initial price. So margin money is not required to pay additional margin. When price is moved, you need to pay, both parties to pay the additional margin. No, not required. Margin money, initial margin. That's the reason name is there. Initial margin, and initial margin, whatever the action has decided, 5%, 10%, it is taken based on the when you open the position, okay, long or short, and then everyday basis it is a MTM. How margin is decided? So as I shared in simplicity, the exchange will ensure the, again good question, again I'm taking 1 minute time to explain you. So suppose price band is plus or minus 10%, example, in a 1 day, okay, that contract Nifty, let's say I'm just taking simple example, we are talking Nifty index, okay, so here let's say it is a 25,000. So exchange is permitted कि Nifty price can move maximum plus or 10% in 1 day, okay. Then there is a circuit, okay, then price cannot go down beyond 10%, okay, example. So in that condition, your initial margin is 10%. So they will ensure that your initial margin is based on the price movement which can happen in a 1 day. If one stock is allowed, example, to move plus or minus 20%, example, in 1 day, it is called price band. If stock is allowed, example, to move from one price, suppose yesterday closing price was 1,000, it can move 1,200 or 800, then definitely the initial margin requirement will be 20%. So initial margin is a minimum, okay, which is the amount which will ensure that if there is a change in the extreme price band, okay, then also there is no loss to the exchange, okay. So if counterparty default, okay, then exchange has recovered the money through the initial margin. So hopefully you have a clarity. So now we are moving to the next question, next important discussion, which is called open interest and volume. So you may expect a question on both concept. So please be attentive. Open interest is the total number of outstanding contract yet to be settled. Now, when we discuss open interest and volume, you have to think from the exchange, not from the your side. Okay, individual. It is from the thinking from the exchange perspective. Okay, suppose in an exchange, okay, if Nifty 50 index, okay, outstanding contract, and that is not settled, example, which is a, let's say 1 lakh, okay, on our 10th June. Okay, so this is from the exchange perspective. Here we are taking an example. So we are thinking from the exchange perspective, equal count for long and short position. So we cannot count from the both side. Okay, it is a one side only. So I'll take example so you'll better understand. Indicator the market depth, open position indicator of market depth. Trading volume measures the daily or periodic market activity, reflect the number of contract traded over the period. So we are taking one simple example. Okay, this is the exchange, and on exchange, what happened on the 1st March? On March 1, A client short the 50 contract, Nifty 50, and B goes long 50 contract. So definitely someone has explained me to that it is the or let me tell you exchange just facilitate the trade between the buyer and trader. Okay, exchange doesn't enter into own trade. Okay, so in that condition, A decided to short. Same time, there is a price match with the B, and B has long the contract. So what is the open interest end of the day? Open interest. So 50 contract. So we have to consider the one side. Either you can consider long side or short side. So open interest is 50 contract. Someone bought 50 contract and someone sold and bought. What is the volume happen in the exchange on that day? So volume of 50 contract. March to again C goes. Okay, this is for the May month, June month contract simplicity. Okay, so the contract is open. Now they have not done any transaction A and B on the March 2nd. Okay, this is a March contract example. But C client long 100 contract and D short the 100 contract. So when two opposite mind okay match the prices, the trade is happened. So now open interest is increased to 150. So 50 was already open, okay, and another 100. So total open interest is 150, and volume how much it is happened? 100. Okay. So hopefully it is clear to everyone. If any queries, okay, you can ask.
Yeah, what happens when the same person opens, or how does it work actually?
Okay, we'll take example. Okay, but any question in this, what we have discussed about open interest and volume?
This is straightforward.
Please, someone asks, suppose D does not exist. So don't imagine yourself. Here we are not for the basically imagination. Here we are learning one by one, say, systematic way. I have an answer for every question, being a CFA charter holder. Okay, so please, when I ask you to ask the question, it must be based on the reference to this relevant slide. And in case if you are not understanding, if you are understanding, then we can simply proceed.
नहीं सर, सपोज इसमें से ए और बी का 2 हुआ, 50 आ गया नेट पोजीशन। अगले दिन मार्च 2 में सी के 100 कॉन्ट्रैक्ट हुए, डी का नहीं हुआ कोई, इसको फिर उसमें
ऐसे
क्या
हो ही नहीं सकते ना, वो आपकी इमेजिनेशन आप कर रहे हैं ना। आप समझिए, एक्सचेंज जो है फैसिलिटेट करता है ट्रेड। आपको पता है कि ट्रेड कैसे होता है, कि जब सामने जो है दो व्यक्ति जो है ऑपोजिट सोचते हैं, और एक्सचेंज जो है बीइंग अ प्लेटफॉर्म अलाउज द ट्रेड, तो आप ऐसे बोलेंगे कि ऐसा नहीं हुआ, वैसा नहीं, कैसे हो सकता है? तो ये तो सब बेसिक चीजें हमें पता होनी चाहिए। इट इज नॉट अबाउट दी थिंकिंग वाइल्ड एंड टेकिंग अ गेस। ओके, so definitely we'll discuss the couple of questions. Okay, let me do it right now to have to.
हेलो।
Yes, tell me.
जी प्रीवियस स्लाइड में चाहिए ना, जो आपने लिखा था, वहां पे आपने ओपन इंटरेस्ट में 150 लिखा, उसके बाद वॉल्यूम में 100 लिखा है, वो समझ में नहीं आया लास्ट वाला।
हाँ, तो आप देखिए, मार्च 2 को सी पार्टी ने लॉन्ग किया 100 कॉन्ट्रैक्ट और डी ने शॉर्ट किया, तो ट्रेड जब हुआ तो ट्रेड कितने का हुआ? 100 का हुआ ना?
ठीक है, हाँ, बराबर बराबर।
ओके, तो वॉल्यूम को ऐसे समझना है कि
सर, तो 1 मार्च को ए ने शॉर्ट किया, बी ने लॉन्ग किया, उसका वॉल्यूम 50 हुआ।
हाँ,
है ना? अभी तो ओपन इंटरेस्ट एक्सचेंज की ओर से देखते हैं तो ए इज अ डिफरेंट पार्टी, बी इज अ डिफरेंट पार्टी, तो ओपन इंटरेस्ट 100 होना चाहिए ना?
मैं वही बात कर रहा हूँ। आप सिंपल सोचिए कि आप एक ग्रोसरी शॉप पे आपका अकाउंट है, ओके, और वो ग्रोसरी शॉप में आप 1 kg शुगर लेने जाते हैं, ओके, तो शुगर शॉप जो है उसने शॉर्ट किया 1 किलो, ओके, यानी कि आपको सेल किया और आपने परचेज किया, ओके। तो अभी आप शुगर शॉप के रेफरेंस से देखेंगे या आपके रेफरेंस से देखेंगे, ओके, दोनों को कंबाइन तो नहीं करना पड़ेगा ना। तो आप क्या कहेंगे कि भाई शुगर शॉप जो है वो आपको आपका जो है वो क्रेडिट है, यानी कि आपका डेबिट है, उसका क्रेडिट है, ओके। तो शॉर्ट और लॉन्ग का मतलब क्या है कि डबल नहीं हो सकता है। एक ने सेल किया है, दूसरे ने परचेस किया है, बट अभी शॉप का वॉल्यूम में गिनो कि भाई पूरे दिन में 1 ही केजी, ओनली 1 केजी शुगर इज सोल्ड, सो आई सेड दैट की वॉल्यूम इज 1 केजी एंड व्हाट इज द ओपन इंटरेस्ट, ओके, 1 केजी। हाउ कैन आई से इट इज अ 2 केजी? गॉट द क्लैरिटी, यस और नो?
नो।
तो मैं वही आपको समझा रहा हूं ना, वॉल्यूम का मतलब क्या है। वो यहाँ पे बहुत क्लियर लिखा है, ओके, इक्वल काउंट फॉर लॉन्ग एंड शॉर्ट पोजीशन, ओके। सो
ओके
वी हैव टू कंसिडर दैट की when so I'm just giving you once again repetition because it is a new subject. It takes time to digest all these things because we are thinking from the as a user, not the from the exchange perspective. So on an exchange first day, two opposite mind met, okay, and they did buy and sell, okay, 50 contracts. So what is the open interest in exchange book? When they close the day, they said that there is a 50 open contract is there, okay, it is yet to settle. Open interest means this 50 contract is yet to settle. What is the volume? They say that there is a 50 volume is happened, okay. So in simplicity you have to consider from the one side, okay. Now second day, another two opposite mind met, okay, and they exchange they trade happen of the 100 contract. So previous contract is not settled 50, so total in a book, exchange book, it is a 150 contract, but on a day two only the 100 volume is happen because the trade is between the C and D only. So there is no need to worry. It is a new subject. It takes time to digest, and if you and I'm sure that some of your queries once we go through the next. Tell me.
सर 1 मिनट, एक ही क्वेश्चन का मेरे को जवाब दे दीजिए ना कि मार्च 1 को ए शॉर्ट्स 50 कॉन्ट्रैक्ट एंड बी गोज टू लॉन्ग 50 की जगह पे अपन 100 ले लेते हैं,
नहीं,
तो
मैं अभी पॉसिबल ही नहीं हो सकता ना, बी कैसे हो 100 एक्सचेंज में कभी हो। इसलिए मैं बोल रहा हूँ कि आप ब्रोकर के सोच से मत करिए। ब्रोकर के वहां पे ऐसा होगा कि जहां पे ए ने 50 किया, बी ने 100 किया, क्योंकि वो हो सकता है। इसलिए मैं एक्सचेंज के थॉट से बता रहा हूँ ना कि जब हम यहाँ पे वॉल्यूम और जो बात कर रहे हैं वो एक्सचेंज का आता है। किसी ने मुझे पूछा था यहाँ पे स्टार्टिंग में कि ये करिए, तो ये कोई ब्रोकर के पॉइंट से वॉल्यूम नहीं होता है। जो ये वॉल्यूम और ये जो हमें मिलता है कि नंबर ऑफ कॉन्ट्रैक्ट ट्रेडेड, ओके, दिस इज फ्रॉम द एक्सचेंज पर्सपेक्टिव। व्हाट इज द टर्नओवर? इट इज फ्रॉम द एक्सचेंज पर्सपेक्टिव। सो वी नेवर एनी ब्रोकर सेज दैट कि मेरा इतना वॉल्यूम या उसके कोई सिग्निफिकेंस नहीं है। इट इज मोर फ्रॉम दी concept and the you can say अपने calculation point of view, it is from the exchange point of view.
ओके ओके गॉट इट।
आपका कहना ये है कि अगर एक्सचेंज के इसमें क्वांटिटी बाय और सेल का सेम ही होने वाला है
100% ना, तभी तो कॉन्ट्रैक्ट होगा ना।
वही इसीलिए वो मैच हो रहा है आपका 50। अगर हम ब्रोकर के इससे देखेंगे तो वहां पर कंफ्यूजन हो सकता है।
ब्रोकर तो ऐसे 100 ब्रोकर्स है ना, तो कहीं ना कहीं
तो मतलब जितना बाय हुआ है उतना एग्जैक्ट क्वांटिटी
एक्सचेंज की ओर से देखेंगे, हेलो, एक्सचेंज की ओर से देखेंगे तो एक ट्रेड होगा तो एक ने बाय किया है तभी तो दूसरा सेल करेगा।
तो इसलिए तो मैं आपको समझा रहा हूँ कि ये जब हम कर रहे तभी एक्सचेंज के सोच रहे, अदरवाइज तो हम कर ही नहीं सकते, क्योंकि ये एक क्लैरिटी आ ही नहीं सकती है। तो बहुत इंपॉर्टेंट है कि हमें एक्सचेंज के पॉइंट से सोचना है और एक्सचेंज के पॉइंट से ही हम कैलकुलेशन कर सकते हैं। तो हमने यहाँ पे ये डिस्कशन को अभी हम क्वेश्चंस है, बट आई एम नॉट राइट नाउ गोइंग, ओके, मैं लास्ट में लूंगा क्योंकि
सर बेटर अंडरस्टैंडिंग यू कैन ऐड 1 more day for understanding better understanding.
Definitely, we
Along
can
with
one day, 2 day, no issue. But let's see, right now management has decided 20 hours of training. So we are doing 20 hours of training. Okay. And I have already shared my email ID and mobile number. If
Sir,
you
you are understanding, you are mistaken. Day means here for the present example, March 1st, March 2nd, March 3rd.
No,
That
I
is
understand.
my
We will we will we will do it right now. But right now, my objective is to learn about the concept only. Okay, it is not about the calculation we are going to learn. Okay, so in that condition, suppose on a March 3, okay. Now again, I have to copy paste it, and it is not. It is into. I'll just open.
yes.
So here only we can say that on March 3, okay, I'll use this page only. So in March 3, okay, from exchange perspective, let's say ki A want to close this position, okay. So A long the 50 contract. Suppose A decided to close the position, okay. So A long the contract, okay. And let's say a new client has come, okay, and short the 50 contract. So what happened that on a March 3, okay, 50 was the first day 50 open interest, second day 100 plus 50, 150. Now on third day, what happened that someone closed the position and new party has come, okay, and opened the position. So it is like a same 150. Okay, because here position is closed and here new position is open. So open interest remain the 150 only. Okay, and volume become a 50. So this is one more example to you. So when position is closed, okay, it is removed, but same time why it is a open position is same, because the E has come. Now instead of E, okay, if I say that D has C has because A has short and B long. So let's say B also close the position. A close the position full by long, and let's say B short the 50 and partly close the position. Okay. So in that condition, volume will be 50, but open interest will reduce to 100 because 50 contract open position was closed down by the existing parties.
Sir, one question, sir. You said the open interest is the trades, the contracts which are not yet settled.
Yes.
Once the contract is settled, sir, it is T plus 2 days or T plus 1 day. So
no, contract is settled on maturity, na, because it is a future contract. Na? So future contract, suppose you bought a June month future contract on 11 June, and let's say expiry is 25th June example. So you have an option to keep your contract open till the June 25. Na?
okay, sir. Okay, sir. Got it. Thank you.
Okay, so it is not necessary. Only what you need to do, future buyer and future seller, is to apart from the initial margin, they have to ensure the MTM payment. Okay, so those who are getting a profit, they will they will earn the MTM profit, and seller, someone is losing money, they will basically pay the MTM. Okay, so one can continue till the expiry by ensuring the MTM profit loss. Only the contract is expired, okay, on a expired date only. So we are moving ahead in the discussion. Okay, so definition, predefined range. So price band is also important. So base example, exchange has decided 10% band. Then if yesterday closing price was 100, okay, then price will move between 90 to 110. first trading day band is set using the underlying previous closing price. Exchange may expand the band or impose the trading halt if necessary based on the volatility. Now, again, it is a repetitions, long position and outstanding unsettled buy position. So someone has buy position, okay, and not settled. It is called the long position. Example, someone buy 5 Sensex or Nifty future contract, okay, for June month example, and it is not settled today and it is not squared off today, then it is a open. Short position and outstanding unsettled sell position, example, selling 5 contract June month. Open position, sum of all outstanding long and short position in derivative contracts. Update when positions are modified, buying to close a previous sale. So we have discussed the open interest, how to calculate. Now next discussion is about the negged and calendar spread. Negged position, like a unhedged position, it is also called unhedged position. So holding a long or short position without offsetting position in the underlying asset. So speculator or trader, they do not own the physical asset, or you can say in cash market. They just participate in the future market to leverage the profit, okay? Because in future you require, let's say, 10% margin. So for 10 lakh contract, you need only 1 lakh rupees. So profit and loss will be based on the 10 lakh rupees price movement, okay? So they like to go for the unhedged position. Calendar spread will learn detail in coming slides. So in calendar spread, it is not, it is, you can say, a combination of position in future on the same underlying asset but different expiry date. So example, short on the near month contract and long on the far month contract. So long, first one, negged or unhedged position is a complete speculation. Here you can say a conservative speculation. So where you think that near month Nifty is expected to bearish, okay, near month example, but in 2-month contract, 2-month period, Nifty will bullish, okay? So in that condition, you short the Nifty for the June month contract, Nifty for June month contract, and short and Nifty again for July contract, you long it. So in that condition, your objective is to not have a extreme speculation, unhedged speculation, but it is like a based on your thought process of the overvalued and undervalued contract. So it is called calendar spread. Calendar spread are computed relative to the near month contract until the one side close or expiration of the contract. So calendar spread we'll discuss when we solve the question also, we will get more clarity. Okay, so opening a position, initiating a new trade, buying or selling that increases the overall open position. So it is called opening position. Closing position, taking an offsetting trade, selling was bought. Okay, so if you have opened the long position, you want to close your position, then you will do a short for the same underlying. So someone has bought Nifty 50, okay, one lot, June month series, okay, and before expiry he want to close the position. One option is by default it will expire when the last Thursday, okay, last Thursday of this month is 26 June, so it will expire on 26 June, okay. But if you want to close before the 26 June, let's say on a 15th June, so what you will do on a 15th June, you will take a opposite position. So you have bought the contract, so you will short the contract same underlying Nifty 50 for the June month contract. So your position is closed, okay. Reduces or eliminate the existing position. Now we are going to discuss about the payoff structure, how future will give the payoff. In case of the future contract, long as well as short position has unlimited profit or unlimited loss. Okay, so you have to understand that in future contract, both parties, okay, buyer and seller, both have a obligation or commitment. You can say obligation. Okay, both parties are obliged to uh, settle the contract. So they have unlimited profit and loss. So let's take an example to discuss, and then I'll take your query. So payoff for the buyer, long future. Example, trade going for long at 100. So this is stock price is 100. Okay, stock future price is 100. Okay, in scenario one, if expiry price, okay, in spot market 150. So when profit is 150 into 150 rupees, if lot size is 1000, okay, you earn the 50,000. Buyer is earning 50,000 and seller will lose the 50,000. Scenario 2, if expiry price is 70, okay, and you are a buyer, then you lost the 30,000. So this is the simple discussion we have done for the payoff. If you have any question, you can either unmute and ask if relevant question from the slide or previous slide, okay, or if you can post it in a chat box also.
In the previous size, how the position will be increased? We have buy it and we have close it, right? Before the June end. So how the position size is, overall position is open position increase?
Further buying.
No, we buy it and before expiry, let's say after 5 days we short it. First we long it and then after we short it. So we close our position. So if you close our position, then how did this increase the overall open position?
So I'm explaining from the exchange perspective. Okay, when let's say June month contract is open, okay, let's say it was open on the 30th May, example. Okay, so this is the first day. Okay, now expiry is 26 June. So now on June 1 series, Nifty 50 people will start trading, okay, based on the thought process of bullish or bearish, example. So every day there is a new open position created by the different trader, or maybe some trader may close the positions. Okay, so in that condition, when from exchange perspective, I am first explaining, but then I'll discuss from the individual perspective also. So suppose first day it was 100 contract, then it become a 500 contract, 1000 contract, okay, and last it becomes a 0. Now from the individual perspective, I'll explain to you. Okay, let's say Mr. A is a trader, and first day in a June series, okay, first day of the 30th May, he long the 100 contracts. So let's say Mr. A open the position. Okay, now let's say on 31st May, he long the another 50 contract. So now position is 150. Okay, on a 5th June, okay, on a 5th June, okay, he sold 100 contract. Okay, so what is the position? 50 is open, and let's say on a 11th June, he sold remaining 50 contract. So position become 0. So this is from the individual perspective, how individual can increase the position, okay, or decrease the position and close the position.
Correct. But at the same time, this is the true for the exchange also. Exchange also it is 0, right?
Exchange only or expiry, please understand.
Okay.
Exchange for you can close the position before the expiry, but on exchange other traders are there. Na? On exchange we discussed there could be millions of traders, okay, or millions of investors. So on exchange the expiry will become on a 26/0. So last trading day, then this contract will expire. So all June month position will be closed.
So can we say that on the day by day, every month position for the exchange will increase only, and it will be zero at the end of the day, expiry day?
Not necessary. Not necessary. The increase or decrease for exchange depend on the thought process of individual buyers and seller, na? Because if example there is no new, suppose once it is achieved the, let's say open interest on let's say 11 June today, let's say 1 million contract outstanding, and now there are no new buyers are coming, there are no new traders are coming, and old traders are slowly they want to exit. Okay, the open interest may come down also from 1 million to maybe 0.9 million. Okay, 9 lakh, 8 lakh, 7 lakh, and then because so it depends on that what is the position. Okay, normally you have to understand when new month start, position is minimum middle of the month, normally make position reach to a maximum, and then slowly people will start closing the position before coming. It is like you consider intraday thought process only. Okay, 9:15 to 10 people start the position, example, or 11 o'clock. By 2 o'clock they start. Okay,
Yeah, got it.
reversing the position. So it's the same thought process is for the 1 month period contract.
Yeah, thanks.
There are the same lines.
Yes, yes.
There are the same lines. I understand that practically it doesn't work, right? The total number of buyers will always be equal to the total number of sellers, right? So that's where the question on the open interest has raised, because you equally mentioned that 50 buyers and then 50 people who have gone for a short from the exchange standpoint. But in a practical scenario, need not necessary that it will work. No, there are at times that 100 long can go and then 50 shorts can happen. There are 50 can be unsettled, as you said. In that way, how does that open interest work?
No, that you are thinking. Okay, it is not the book thinking. Okay, concept thinking of derivative market. So we can discuss one to one. Okay, I may not understand your question right now. Okay, so we can you have my WhatsApp number, email ID. We can keep it discussion offline. Okay, for the in case we want to further discuss it. So right now we are moving ahead with the payoff contract. Okay, and now next is the
small clarification, sir. If
Yes,
same
yes,
person, same age, enters the contract on one day and closes the contract on another day, every time he has to pay margin, or the
yes,
same
yes.
margin will be adjusted?
No. Please understand. When you are closing the position, you are not obliged to pay margin. No? You are taking a opposite position. Okay, so in that condition, opposite position, you are closing the position. Okay, so in fact, you will receive your initial margin back.
Okay, thank you.
So that margin is required only when you open the new position. Okay. And margin will be returned either on expiry of the contract or when you take a position and close the position. Bond long have a limited loss potential. If price is 100, maximum it can go down to 100. Okay, you are absolutely right. That's the reason people more like to go for the long instead of short. But conceptually, it is mentioned that key unlimited loss and unlimited profit. But you are right, for a price can be maximum zero. But please imagine that key during the COVID, the oil future become a negative also. Okay, so we are thinking that zero is the lowest price, but in reality, in COVID period, oil future become a negative, because when short sellers start selling, okay, so zero cannot be a lowest. It could be a go, because it's a future contract. It is not about the cash market. Okay, it is future contract, so it could be. Negative 100 can be possible, negative 1000 can be possible. That is the theoretically and practically happened during the COVID period. So that's as it is mentioned, unlimited loss and unlimited profit. Hopefully I am able to explain. So future pricing overview. Future prices depend on underlying assets, unique demand, supply, and cash flow characteristics. So apart from the cost of carry concept which we have discussed, okay, future price is equal to spot price plus cost of carry. Okay, and cost of carry is basically interest cost minus, if any, dividend. But apart from this theoretical equation, prices may up or down based on the demand, supply, or sentiment also. No single formula fit all asset to varied characteristics. For equity, it could be different. Commodities can be different. Popular models, cost of carry model is known as a no arbitrage model. We'll discuss in detail. Expectation model discussion in limited will also discuss for 2 minutes. So what is the cost of carry? We'll discuss and then we'll take a break at 4 o'clock. So cost of carry model, okay. So principle, in an efficient market, no arbitrage implies that the synthetic cost of carrying an asset, spot price plus carrying cost, should be equal to its future price. Okay. So as I said, that key future price is equal to spot plus cost of carry. Okay, that is your theoretical price. If this is not equation, then people may this is called mispricing, and trader may, and arbitrager may basically enter and try to profit from the mispricing. So carrying cost include the financing charge, transaction, custodial, storage, insurance charges for commodities. No arbitrage condition is future price is equal to spot plus cost of carry. We discuss any mispricing trigger the arbitrage, aligning cash and future market. So arbitrage may short the future, okay, and long the cash, or maybe reverse cash carry, short the cash and the long the future to make the risk-free profit. So one by one we'll take an example. So Boolean example, data spot price of the gold is 62,130. Spot price is also known as a cash market price. Carrying cost for 3-month gold is 100 rupees per gram. So it includes as we discussed, carrying cost include the interest cost, storage cost. Okay. So we have derived as an investor. Okay. It is 100 rupees per 10 gram. Okay. Fair price for the future contract is 62,230 for 10 gram contract. Actual 3-month future trading price is 62,280 per 10 gram. So fair price is 62,230, which is a fair price, versus actual price is 62,280. So here future price is overvalued. Future price is overvalued. So what we'll do, we'll buy the cash and short the future at same time. Okay. And we'll try to earn the difference 50 rupees as a risk-free profit. So what we are doing, arbitrage opportunity, and it is known as a cash and carry arbitrage. Buy gold at 62,130 in cash market. If required, paisa nahi hai, if required, borrow the fund to finance the purchase. So it will cost you 100 rupees for 3 months. Okay, that borrowing cost. Okay, so hold the gold for 3 months at carrying cost of 100 rupees. Sell the future contract 62,280, and net profit 62,280 minus 62,230, which is 50 rupees per gram. So this is the risk-free profit arbitrager can earn by long the asset, okay, long the asset and short the future. Arbitrage activity drives cash price up and future price down until the convergence. So by doing this thing, okay, the fair future price will come to the near to the fair price, which is a 62,230. Who can decide the 100 rupees carrying cost? This is decided by the investor. This is decided by the investor. We have discussed the carrying cost is different for the every investor because it includes the interest cost, it includes the storage cost for commodity, okay, or if any cash flow is deducted. So it is the investor to investor. Now investor in this, okay, decides the 100 rupees is a carrying cost, okay, and he feels that this future price is example overpriced, and try to encash from the selling the future contract and same time buying the cash market, and maturity after 3 months he'll be able to generate the 50 rupees actual price. Okay. Now, second option is the reverse cash carry. So in reverse cash carry, okay, future price is lower than the fair price. So chances is that when we calculate the spot plus cost of carry, which is the future price, okay, here the future price is lower. So instead of in same example, theoretically example, 62,230 is the fair price, but this current price is 62,200 rupees only. Okay, this is the current price, and actual price is 62,230. Actually, that's a fair value price. So here the future contract actual price is undervalued. So what is the arbitrager does? Arbitrager buy the future and short the cash market. So opposite. So market participant buy the future market and sell in the cash market. Trader may borrow asset in the cash market, sell it immediately, later cover by buying the future market. So it is like short selling the asset and buying the future. This reverse arbitrage drive the spot price down and future price up until the equilibrium achieved. We'll discuss also some questions. Last slide we'll discuss and we'll take a break. Transaction cost and no arbitrage bounds. Key idea: transaction cost like margin, commission, taxes introduce market friction. No arbitrage bound means range. These costs create a range around the fair price. If actual future price fall within this range, arbitrage is not profitable. So if your cost is higher, okay, then chances that arbitrage is not profitable. Market efficiency: wider the range indicates market are faster, far from the equilibrium. Lower operating cost, narrow range promoting the efficient alignment. Okay, so let's take some question. If you have any question, we'll take a 2-3 minutes and then we'll take a break. You can write it in a chat box also, okay, or you can unmute and ask the question if required.
Sir, actual future prices falls within these bounds. Arbitrage is not profitable. ये
बोले
आर्बिट्रेज रिजर्व को प्रॉफिट तो रिवर्स कॉस्ट ऑफ कैरी नहीं करके करेगा प्रॉफिट सर?
नहीं, दोनों में बात कर रहे हैं कि सपोज इन रियलिटी when you basically buy the future, you have to pay the taxes, okay, which is a STT, etc. When you sell, again you have to pay some taxes. So when you consider the transaction cost, and by considering transaction cost in this example, first example I'm only, okay, you feel that the transaction cost is, let's say, 150 rupees, example, transaction cost and taxes. So now what happened that if 100 rupees example, so now your profit by taking difference is 50 rupees, but your transaction cost is 100 rupees. So it is within the range only. Okay, so you will not like to go for it. You will like to go for it when it is a 150. Okay, so your 100 rupees is transaction cost and taxes. So even though after moving that transaction cost and taxes, you will be able to earn the 50 rupees. So this is called the range. So range is fair price is 62,230 example. Okay, but because of transaction cost of 100 rupees, okay, you said that 62,130 and 62,000, let's say 330, you may not able to trade because of that transaction cost.
Okay.
So let me, before going for the break, let me just quickly do a quick revision for the benefit of all. Okay, because a lot of thing is new. So you need to invest more time. As I discussed yesterday also, ki every day you should morning time before attending a session, at least you invest 1 hour and do revision what you have learned in the your session. Suppose you can do revision of what you have learned today. Okay, so when you attend the session, even if you're getting a 50-60%, it is good. And when you start revising, your understanding level will improve. Okay. So we started with the understanding the forward contracts. This is the features of the forward contract, limitation of forward contract, future contract features and limitations. Okay, we discussed the differences also, and then we move to the equity derivative, and the first contract is the Nifty 50. So we learn the various terminology about the Nifty 50 contract. What is a contract cycle? What is a contract multiplier? So it is a multiplier is 50 example. What will happen on expiration day? What is a tick size for Nifty 50 contract? Okay, what is the procedure for daily settlement, final settlement, trading hours? Question may ask as simple as what is the trading hour for the Nifty 50 index contract? Okay, then basis we have learned why there is a difference between the cash market price and the future price. So we have learned that there is a cost of carry is there. That is the reason there is a difference between the cash market price and the future price. So it is known as a basis, spot minus future price, negative basis, positive basis. Cost of carry also we have understood in detail. Okay, in equity derivative, cost of carry is interest minus dividend. Then we took one simple example. Initial margin we understood. Then marking to market MTM, profit loss, open interest and volume. Again, it's a new subject. When we solve the pre-training and post-training test as well as some question, it will give more clarity. Then various positions, long short position, open position, net versus calendar spread. Okay, opening position, closing position, payoff of the future contract we have discussed. Cost of carry model we have discussed. Okay, we took an example. Then reverse cash of carry model we have discussed. Okay, so let's take a one break. Right now it is a 15:55. So we'll take a 10-minute break. Okay. Let me first take a break right now, 10 minutes. Okay, and then we'll continue from 4:05 with your question. So if you have any question, we'll discuss. Now what I'll do, I'll share you a PPT also. So those who have not downloaded the PPT, okay, they can download the PPT also. So if you have any query, you can unmute and ask the query before we move ahead. So no query, let's move ahead with the our next discussion. Again, we are taking one more example, extending the cost of carry model. So fair future price is equal to spot price plus cost of carry, okay, minus inflow. Okay, so cost of carry we have considered example interest from equity point of view. Inflow means example dividend. So cost of carry includes financing, storage, transaction cost, inflow like dividend, interest, or any return during the holding period. So here it is a simple example is there. Okay, index future spot price is 17,500. Cost of financing. Now this is for individual. This is for the individual. So that cost of financing may be different for the different investors. So here given cost is 12% and holding period return. Okay, this is common for everyone. This is common for everyone. Example, as per example, it is a 4% dividend yield is expected. Okay. Theoretically, it is given. Otherwise, Nifty 50, we know that dividend yield is approximately 1.5%. But we are just going with the data. So time to expiration is 90 days. So calculate the yield a fair price. So how to calculate the fair price? So cost of carry is equal to 12% minus 4%. It is the 8%. Now 8% is the cost of carry for annual, okay, for a 1 year. Now 8% of 17,500. So if you use your calculator, so 8% of 17,500 is equal to 1,400. But this is for entire year. So for 1 month, if we divide by 12, it is the 116.66. Here it is for 3 months. So into 3. So it is 350. Okay. 116 into 3 is equal to 350. So what is the price comes? 17,500 plus 350 is the cost of carry. So here the future price for the 3 month expiring, okay, the fair price is 17,850. Hopefully this example is again helpful to get the clear. Okay, good, very good. So arbitrage trigger if market future price is above the fair price. Suppose here it is the 18,000 example. Okay, so then there is an opportunity for arbitrage. So it can be a cost of carry where sell the future and buy the cash. Or if it is a 17,500 example, I'm taking 17,600 example. So it is the reverse cost of carry, sell the cash and the buy the future because it is lower than the fair price. Again, you have to understand that there could be a consideration of taxes and charges. So let's say if 50 is taxes and charges, 50 point. So in that condition, 17,900 and 17,800 example, in this range, there is no arbitrage is possible because of cost for the arbitrage, which is a taxes, charges, etc. So if beyond the range, then the charges is, then there is a possibility of the you can say arbitrage. Assumption of the cost of carry model. Core assumption, underlying asset is abundantly available in the cash market, so it is easy, volume is there. Okay, demand and supply of assets are non-seasonal. Holding and maintaining asset is feasible and low cost. Asset is shortable. There are no transaction cost, taxes or margin requirement. So this is theoretical assumption for the cost of carry. Why I have mentioned, maybe it may ask in some theory question, okay, if for a cost of carry, any seasonal product, we can use this model. So no, because it is only for the non-seasonal product. Okay. Practical consideration, in reality, this factor transaction cost widen the no arbitrage range. Seasonal assets or non-shortable asset like commodities may not fully confirm the assumption, so may not able to derive the fair price based on the cost of carry model. Okay, so now moving ahead, one more important concept is there. It is known as a convenience yield. Again, why I am discussing it is reference to the exam theory question can be asked. Okay, there is a statement and you have to identify okay, this statement is based on the convenience yield. Okay, yes or no. Okay, so convenience yield, an intangible return or mental comfort from holding the physical asset. Okay. How it works: in time of scarcity during the natural disaster, holding a commodity may provide additional non-monetary benefits. This yield offered offset the portion of the carrying cost. So again, in carrying cost, we consider the mainly interest cost minus dividend, okay, minus we can use for convenience yield, but now this is only used in the commodities only. It is not applicable in the convenience yield, not applicable in the financial asset. So what we are learning right now, financial asset derivative like equity derivative or interest rate derivative or even currency derivative, the convenience yield is not there. But reference to the examination, we are learning for commodity, there is a convenience yield is there. So in convenience yield, that individual party will consider in percentage term, maybe 0.5%, 1%, or and then it is deducted from the cost of carry. Market impact can cause future to trade at discount related to the cash market. Reverse arbitrage may unfeasible if short selling is limited. Applicability primary observed in consumption asset like commodities, not typically in financial asset. So I have clearly explained the convenience yield is only applicable in commodities, not into the financial assets. So hopefully it is clear to everyone. Any question, you can unmute and ask the question or हाँ
सर फ्यूचर प्राइसेस भी कम हो सकती हैं, चलो हमने माना वो उसके क्या, एक तो डिमांड सप्लाई के वजह से, कि और भी कारण हो सकता है फ्यूचर प्राइसेस का डाउन होने का?
नहीं, अभी कन्वीनियंस यील्ड का मैं क्वेश्चन पूछ रहा हूँ, तो कन्वीनियंस यील्ड यू अंडरस्टूड, यस और नो?
यस सर।
ओके, सो नाउ जो आपने बताया कि फ्यूचर की प्राइस जो है चेंज होती है, तो एक तो पहले तो कॉस्ट ऑफ कैरी मॉडल उससे थियोरेटिकल प्राइस आती है, ओके, एंड नाउ ये जो हमने थियोरेटिकल प्राइस यहाँ पे आई, ये एग्जांपल 17, 80, 50. Now, if example there is a more demand for the particular stock or index, okay, in the bullishness is there, then the future can be overpriced also. If there is a negative sentiment in the market, okay, that future can be lower also. So it depends on the price, future price depend on the sentiment and as well as demand and supply. Okay, so we are moving ahead with the next one model. Okay, so first we discussed no arbitrage cost of carry model, and now second model is expectation model for the future pricing. Okay, so it is limited in the curriculum, so I'll just quickly discuss. So future prices are driven by the market expectations of the spot price will become contract at expiry. Again, I'm reading future prices are driven by market expectations of what spot price will be at a contract expiry. So example, I'll just take an example. Just simplicity, better understanding, gold spot price is for 10 gram, example, I'm saying 95,000 example. Okay, and 3 month future price is, let's say 90,000. Okay, so what it suggests that now we are discussing expectation model, not cost of carry. So expectation model suggests that in next 3 months, gold price is expected to down, gold cash price is expected to down, and that is reflected by the future contract price. Okay, so after 3 months, okay, this price will be your spot price. So this is the one scenario. Another scenario could be his spot price is 95,000 and future price is, let's say, 105,000 example, 3 month contract. So it says that gold price in next 3 months is expected to increase. Okay, and after 3 months, future price will be 105,000. After 3 months, spot price will be 105,000. So that's the reason it is showing this price today. So it is known as a expectation model. So here you need to learn two most important concept and information, okay, which you have to remember. Contango means future price is above the spot price. So future price is, let's say, 1 lakh rupees for 10 gram gold. 3-month contract 10 gram gold is 1 lakh rupees. Okay. And spot price is 95,000. So when future price is higher than the spot price, it is known as a contango. Okay. And indicate the market anticipate rising the spot price. So what indicate that market is expected to rise future price in next 3 months. When future price is less than the spot price is 95,000 and future price is, let's say, 90,000. So it is known as a backwardation. Signals market is expected to falling in the future spot price. So after 3 months, spot price will be expected to be 90,000. Implication for trader: future price act as an indicator of future market sentiment and expected spot price movement. Hopefully it is clear. If any question, you can ask. If basis is negative, bullish, and positive is a bearish. Yes, you are right. Basis, because basis is difference between the spot price and future price, and basis is like spot minus future. So if spot price, future price is higher, so we got the negative basis. Okay, so it is bullish, and positive basis is bearish. But here we have learned from exam point of view 2 new word. So you have to remember these 2 new word: reference to example. Okay, reference to exam where question can be asked. Okay, and you have to decide whether it is contango, backwardation. Okay, so this is the reason I have explained to you. When we move ahead, price discovery and convergence of cash and future prices on expiry. Expectation hypothesis: future prices represent the market anticipated spot index level at contract price. Okay. Price discovery process: market participant align single predicted spot value at expiry through active trading. Convergence principle: we know that at maturity, future prices and actual spot price converge, leading to all future contract to settle the underlying cash market. So now we are moving how the future contract will be used by the market participant. Okay, we have thoroughly understood about the future contract, reference to one example of Nifty 50 index contract. Okay, and then cost of carry model, reverse cost of carry model, expectation model. So how this use of the future by the market participant. So there are 3 market participants we discussed yesterday. Quickly revisit. Hedger, their objective is to reduce the exposure to the risks such as interest rate risk, share value, bond price, exchange, etc. Example: a farmer sell future to lock the price for a future crop delivery because he is worried about the price drop in future. Investor with diversified equity portfolio sell index future to guard against the short-term market movement. Okay. Arbitrager, as we discussed, definition: exploit the price discrepancy for the risk-free profit. Okay, buy an asset on one market where it's cheaper and simultaneously sell the where it is a priced high, or maybe within the same asset, buy the future and sell the spot based on the cost carry model. Rapidly reduces mispricing and maintaining price efficiency. Market integration: hedger aims to transfer risk. Okay, so their objective is to reduce risk. Okay, so they transfer risk to the other participant. Traders or speculator willingly assume the risk and provide market depth. Arbitrager help align market price difference across the different venues. So again, it is important reference to the exam. Okay, what is the objective of hedger? They want to reduce the risk, so they transfer their risk to the other market participant, either trader, speculator, those who are willing to take the risk. Okay, and arbitrager, they use small price mispricing opportunity and try to benefit from the mispricing opportunity. We'll discuss convenience yield little bit later. Okay, let's complete the first the PPT. use of the index future overview and price risk. Okay, so equity derivatives and price risk facilitate trading by mitigating the price risk, adverse price movement of the asset. So price risk we know broadly divided into two parts. One is the unsystematic risk. Okay, suppose if you are holding only one stock, okay, so it is carry the both risk. Okay, systematic risk. Systematic risk means market risk as well as the stock specific risk. Okay, so it is known as a stock specific risk is known as a unsystematic risk. We have discussed in detail in PMS exam training. Individual unique to the individual companies or industries can reduce by portfolio diversification. Instead of holding one or two stock portfolio, you can construct the diversified portfolio, and by constructing the diversified portfolio, that unsystematic risk can be minimized. Systematic or market risk affect the entire market, like example monetary or fiscal policy, exchange rate fluctuation, geopolitical events. So it is for the entire basket of the stock, entire market stock remains after the diversification and is managed with the index-based derivatives. So someone is holding the 1 crore diversified portfolio and is worried about the that is holding and is worried about the short-term downside of the market, okay, or the portfolio. So to hedge that, what he can do, he can short the Nifty index. Okay, we'll discuss in detail in upcoming slide to reduce the risk. Single stock future hedge the total risk of single equity. Suppose if I'm holding a single stock and if future is available, so I can use the single stock future to hedge the risk. Typically use the 1-to-1 hedge ratio, hedging 550 shares of HDFC Bank. Someone is holding, investor is holding, okay, or owning, okay. So with one future contract, then short the position in the future HDFC Bank. Index future to manage the systematic risk. The ideal for hedging the portfolio market risk within individual stock future are unavailable. Challenge is hedging instrument index future represent broader market than the investor portfolio. Portfolio market sensitivity may differ from the index. So for that we need to do a basically adjust with the beta. So again, this is discussed in detail in the PMS exam training. I'm just revisiting quickly. Measures how a stock or portfolio moves related to the index beta of market. Okay, let me just do a quickly check from your side. Okay, so what is the market beta? You can write it in the chat box. I want to know how many are active listener. Very good. So market beta is 1. Okay. This is market beta, or you can say Nifty 50 example right now, index. Now, suppose if your portfolio is aggressive above 1, now we don't want to go right now how to calculate the portfolio beta because it is beyond the syllabus. Okay. So it is above 1. Okay. If portfolio is conservative, it is known as a, or stock or portfolio is conservative, beta is less than 1, we call it conservative or less volatile than the index. Okay, we know how to calculate the portfolio beta. So it is a weighted average of individual stock. So 4 stocks with different beta and different weight. So we can multiply 0.5 into 0.35 plus 1.1 into 0.15, 1.3 into 0.20 plus 1.9 into 0.30, and we can calculate the beta of the portfolio. Now this is important reference to the examination. Okay, so hedge ratio for index future. Suppose how we can decide. Okay, Let me take one more question. I'll take a first question from your first. Let me give you data. Suppose to better understand, I am starting with the question calculation question. Suppose your client Mr. A holding a diversified stock portfolio rupees 1 crore and beta of the portfolio is 1.3. Okay, and right now he is worried about the short-term volatility and wants to downside protection. So you are example advisor and you are suggesting, so you will suggest you have to write in the chat box, you will suggest long the future or short the future. That is the first most important. What you will suggest, long the future or short the future? Good, very good. So good understanding. So there is a learning and digesting the learning, applying the learning. So as client is already owning the asset, okay, so client is already long. Client is already long on portfolio, long. So to reduce the downside volatility or lock the price, okay, lock the portfolio value, client need to take a opposite position, okay, which is a short position. Now to take, so first we have got the client need to take a short position, okay. So example Nifty 50, example index is 25,000 simplicity or 50 lot, 50 is contract multiplier, so 12,50,000. Now how many contract, our objective is to calculate how many contract needs to short. So need to short. So for that, what we need to do, first we need to calculate the portfolio beta adjusted value, because we know that market beta is by default 1. So we have to adjust portfolio value. So portfolio value is 1 crore and beta of the portfolio is 1.3. So what is the beta adjusted portfolio value? It is a 1.3 crore. Now, what is the contract value? Nifty contract value 12.5 lakh. So now when you do 1.3 divided by 12.5 lakh, okay, you can do it in your calculator. Okay, 1. So you will get approximately 10.4 contract. Okay, so answer is 10.4. So client can take a 10 contract short to protect the downside of the portfolio. Hopefully everyone is clear. Good, 10.4 lot. So we have round off with the 10. So same what we have discussed is here it is explained in the theory term. What we did, we converted number of contracts. Okay, so it's a finally it's equation how to calculate number of contract portfolio value into portfolio beta. Okay, portfolio is 1 crore into portfolio beta is 1.3. Value of index of future contract. Okay, so it is a 12.5 lakh. Okay, so value of index future, how we have derived future value of index level, which is a 25,000 into multiplier. So this is how we have explained you to, which is helpful as in theory question as well as in the practical question. Hedge ratio depend on the historical relationship between the portfolio and index. Different indices may yield the different ratios. So now next, some of the important discussion reference to the examination point. What is a long hedge? Okay, when hedge is there. Hedge can be called long hedge, short hedge, cross hedge. So we are discussing with the first, what is the long hedge? Expecting to receive a fund in the future and invest. Suppose you have a one LIC policy which is maturing on a 15th July, and you are expected to receive 10 lakh rupees maturity amount. You have signed up the formalities and given a bank account. So LIC confirm, okay, you will get the 15 July in your account 10 lakh rupees. And with this amount, you have decided to buy the example stock A. Okay, price is example 1000. But today is 11th June. Now you are worried as an investor that stock A price may go up in next 1 month, and I may have to buy at higher prices. So how you can lock your price? Okay, objective is to lock your price, example 1000. So you can do a long hedge. So go long in the index future to lock today's price. Now here I have taken an example of stock. So you go long on a long, and you buy the stock A future. Suppose 1000 rupees is price. So 1000 and contract multiplies 100. Okay, so let's say it is a 1 lakh rupees. So you need to buy a 10 contract, okay, of stock A. So your price is locked. Okay, profit on the future partly or fully compensate for adverse cash market movement. We'll take example in next coming slide. So by doing this, what happened that now you have long the contract, so your price is fixed. If cash market price is increasing, okay, then your future price will increase. So you will benefit from future, and your that future profit will use for the payment of the this. I'll explain you for more detail. Let me just give you calculation question. So let's say the future of the July contract is 100 rupees price, and you want to lock the this price. Okay, so in that condition, you bought the 10 contract. Okay, and you lock the price on 15 July. The stock price is 120. So what happened that in a cash market you have to buy 120, but in future you got a profit of 20 rupees per stock because you bought it at 100. So that 20 will reduce your cost. This profit will reduce the cost, and your effective cost will be 100. Now in case price become a 80 rupees, okay, so in future you will have a 20 rupees loss. Okay, so that 20 rupees loss is added. So again it is a 100. So in any situation, okay, when market price go down, you are getting lower price in 80 rupees in future cash market, but you bought the asset at 100 in future market. Now when expiry the price is 80, so you have a 20 loss. So 20 loss is added in the cost. So your cost is 100. So in any situation, your price is locked to the 100. So it is known as a long hedge, where you are expected to invest on specific date, okay, and you bought the contract and you lock the price. So in any moment, whether positive or negative movement of the price, your price is fixed. In short hedge is used when planning to liquidate a portfolio while fearing a declining the price. Suppose you want to withdraw 10 lakh rupees from a, let's say, stock XYZ portfolio. You have a 10 lakh rupees stock XYZ portfolio, and after 3 months you want to sell this XYZ stock, okay, and you want to fund your son's higher education. Now what happened that you are worried that next 3 months the stock price may go down, okay, so you basically owning the asset, so you will short the index future, or in this example we'll short the stock XYZ future. So in any situation we have locked our price. Suppose XYZ stock price is 500, you have locked the price. So I'm not repeating the example which we discussed. So benefit future gain can offset losses in the cash market if price fall. Third is the cross hedge. Sometimes no direct future contract is available for the assets. So in that condition, use the future on the related assets, like hedging the jet fuel with the crude oil future. Okay, so in that condition, it is known as a cross hedge. We are not able to hedge with the exact asset, but we are using the relevant asset, hedging jet fuel with the crude oil future. Example, index future hedging portfolio with different underlying names. So sometimes we may not able to get exact stock. Okay, so we may use with the relevant sector same different stock. One more important discussion is known as a hedge contract month. Okay, suppose you want to in this example we took a date of 15 July. In this example, we use the date 15 July. In 15 July, you want to buy. Okay, so in that condition, you should go for the contract which expire on July end, not before. Okay, so it is called the hedge contract month. The hedge contract month says that selection rule, choose the contract expiring just after the intended market transaction. Suppose you want money in July, then you should go for July contract, not June contract. For selling a portfolio on 20th June, June expiry index future, not the May, because June expiry index future will expire on 26th June. If you have any question, you can write in a chat box. Then why not sell portfolio rather than executing new transaction? So
सर इट इज रिलेटेड टू द शॉर्ट हेज के बारे में मैंने पूछा था। आपने कहा था कि शॉर्ट हेज में पोर्टफोलियो 3 महीने के बाद सेल करना है, लेकिन ही इज वरीड कि पोर्टफोलियो नीचे आ जाएगा, तो ही इज सेलिंग मतलब फ्यूचर सेल कर रहा है। तो फ्यूचर सेल करने के लिए पोर्टफोलियो सेल कर देगा। व्हाई व्हाई मतलब हेज क्यों करना है पोजीशन?
Yes, you are absolutely right, because you need money after 3 months. Okay, so one is that I can sell the today itself, okay, and cash market. Okay, but there is another option is that I can keep basically opposite. That's a derivative position. Someone has answered that it could be used because of lower costs and taxes. Okay, so that could be a reason. Mainly, short hedge is used not someone is selling for permanently. I may took a little bit different exam. Normally, short hedge is used when you are worried about the short-term volatility. Okay, you are holding the asset. Okay, but you are worried about short-term volatility. So you short the asset. In earlier example, we use example. I think that example. This is the example.
That means you are saying कि अगर पोर्टफोलियो में लॉसेस होने वाली है या वोलेटिलिटी होने वाली है, वो उसको प्रॉफिट को लॉक करने के लिए हम शॉर्ट हेज कर सकते हैं।
हाँ जो ये एग्जांपल हमने कहाँ गया एग्जांपल, ये कॉन्ट्रैक्ट हमने ये लिया था ना एग्जांपल। सपोज मिस्टर ए इज होल्डिंग डाइवर्सिफाइड स्टॉक पोर्टफोलियो 1 crore, ओके, एंड वरीड अबाउट शॉर्ट टर्म वॉलेटिलिटी। तो ये उसमें जो किया, उसने क्या किया, शॉर्ट हेज किया बेसिकली। ओके, so this is the more relevant in terms of concept. If you are planning to sell permanently, then best option is that you can sell and put money in cash, and cash can earn the profit. What could be the cross hedge oil against the dollar business? What is the question? Cross hedge oil against? So cross hedge is basically you are not able to find the exact asset. So airline company want to worried about the increase in the jet fuel prices. Okay, so basically they cannot long the jet fuel prices. So what they can do, they can hedge against the dollar. So they can long the crude oil. So if crude oil increases, they will make the profit in the crude oil future. but same time they will pay the higher prices in cash market for the jet fuel because crude oil and jet fuel has a positive relationship. Okay, so let's move ahead in the discussion.
सर ये क्रॉस एज करता है,
हाँ बोले ना।
एज करता है लेकिन वो डाउन आने की डर की वजह से एज करता है लेकिन डाउन नहीं आता, मार्केट अप जाता है, तो उसको लॉस पड़ेगा?
नहीं, क्रॉस हेज में तो आपका जो क्वेश्चन क्रॉस हेज का तो हो गया ना, अभी दूसरा क्वेश्चन कह रहे पूछ रहे हैं ना।
हाँ नहीं, एज करता है वो पोर्टफोलियो के अगेंस्ट।
ओके ओके, तो डेफिनेटली आपको समझना है कि आप जब हेज करते हैं तो आपका डर था डाउन जाने का, अभी समझो कि डाउन नहीं गया तो अब गया तो कैश मार्केट में प्रॉफिट हो रहा है ना। तो बेसिकली क्या हुआ कि आपका प्राइस लॉक हो गया। हेज का ऑब्जेक्टिव क्या है? प्राइस लॉक करना। ओके, तो मेरा प्राइस मैंने लॉक कर दिया, तो उसके बाद समझो कि अनफेवरेबल सिचुएशन में मैंने शॉर्ट किया और समझो कैश मार्केट में प्राइस बढ़ गई, तो आई एम होल्डिंग द कैश मार्केट पोर्टफोलियो। तो मेरा 1.3 करोड़ का पोर्टफोलियो 1.5 करोड़ हो गया, बट आई लॉस्ट 20 लाख रुपीज इन दी फ्यूचर। सो फाइनली मेरे पोर्टफोलियो की वैल्यू क्या रहेगी? 1.3 करोड़ रुपीज। सो आई एम लॉकिंग माई पोर्टफोलियो वैल्यू विथ हेल्प ऑफ हेज। कोई भी हेज करता हूँ, लॉन्ग हेज करता हूँ, शॉर्ट हेज करता हूँ, क्रॉस हेज करता हूँ, मेरा ऑब्जेक्टिव क्या है कि मेरी जो प्राइस है उसको मैं लॉक कर दूं।
बराबर, यानी प्रॉफिट लॉस नहीं होगा, वो ही रहेगा।
हाँ, यानी कि आप जो है कल देखेंगे उसमें आप ऑप्शन जब हम लर्न करेंगे कल, उसमें ऐसा आएगा कि आप डाउन साइड को प्रोटेक्ट कर सकते हैं प्रीमियम पे करके और अप साइड को ओपन रख सकते हैं। तो कल हम लर्न करेंगे। दूसरा ऑप्शन ये आ सकता है कि आप अपना पोर्टफोलियो हेज करना है 1 करोड़ का, तो आप क्या कर सकते हैं? 1 करोड़ के पुट बाय कर सकते हो, 1.3 करोड़ के इंडेक्स के पुट बाय कर सकते हैं। तो पुट आपने बाय कर लिया तो डाउन जाता है तो आपको डाउन साइड जो है वहां से पैसा आ जाएगा, पुट आपको रिकवर कर देगा पैसा, अपसाइड आपकी ओपन रहेगी, बट उसके लिए यू आर पेइंग अ प्रीमियम। ओके, फॉर दैट। सो we'll discuss tomorrow one more important product in the derivative market, which is the option product. Okay, now we are going ahead. Trading in future market and spread position. तो ऑलरेडी हमने डिस्कस कर लिया है कि देयर कुड बी नेट पोजीशन। नेट पोजीशन मींस अनहेज और स्पेक्युलेटिव पोजीशन। सो ऑब्जेक्टिव ऑफ स्पेक्युलेटिव पोजीशन इज टू प्रॉफिट और लॉस। Okay, so long position when expecting the price increase, short when expecting the decline. So trader thinking that the particular stock or index is expected to increase in particular period, so he can go for a long, or if it is expected to decrease, go for a short. Profit or losses realized when profits position are reversed at a favorable or unfavorable prices. Spread position consists of two opposite positions simultaneously. Calendar position, so it is called time spread, use contract of different maturity on same asset. Inter-commodity spread, blend the position related commodities. Note, spread position are conservatively speculative as they hedge the risk. We'll discuss tomorrow in more detail. Arbitrage already we discussed. Okay, so I am not going again. Let's discuss quickly. What is the objective of arbitrage? Achieve the risk-free profit by exploiting the pricing discrepancy. Mechanism simultaneously purchase and sell one or different market. So we discuss about the cash and carry arbitrage, reverse cash and carry arbitrage, or inter-exchange arbitrage. Conclusion, risk role of futures in the risk management. So risk management tool. So future provides quick, cost-effective method to adjust the portfolio risk. They enable both risk reduction, hedging, and risk addition for speculating or price discovery. Key takeaway: mastering hedging terminology, trading techniques, and arbitrage strategy is essential for effective portfolio restructuring and market risk management. So here we conclude the chapter 3. So what we do first, we'll go through the post-training test. Okay, and when we discuss the post-training test and pre-training test, when we solve both 20 questions, okay, chances that the queries you have will be sorted out. So I am sharing the link. Okay, and when you click on the link, okay, so this is the SIF post-training test day 2 equity. So you have a 10 minutes time. In 10 minutes time, you have to read the question twice, read the options and solve the question and submit. So it is the 16:46, 10 minutes time till 16:56. So I request you have invested 3 hours, almost close to 3 hours, 2.5 hours in last. Use this learning and solve this paper.
हेलो सर, आपकी आवाज नहीं आ रही है।
अभी टेस्ट चल रही है।
ओके ओके
तो लिंक मैं फिर से शेयर कर देता हूँ।
ओके।
So last 5 minutes, 5 मिनट ऑलरेडी कंप्लीट हो गई है। तो लास्ट 5 मिनट टू सॉल्व। Okay, last 2 minutes. Last 2 minutes to submit. Okay, I request to submit. So average score was 5.63 for a group. Okay, number of submission 64. Right now we got 4750 submission, and average score is 6.27. So it means that the entire group has successfully passed. Definitely, understanding level was relatively good, 5.63. So we need to do extra effort, 10-20% extra effort. And I'm sure that when we solve all 20 questions and when you do a post-training preparation, you will able to score maybe 80, 90 also, yani 8, 9 out of 10. Okay, so let's start with the post-training test question. Okay, so one by one, we are starting with the post-training first. A pension fund expect 500 crores in next 3 months to invest in equity. It buys the Nifty future now to protect against, okay, and known which type of the hedge. So here we discuss in last slide only. Okay, there is a expected investment, but not today, but 3 months. Okay, and you want to worried about the increase in price of the stock or market, so you will do a long hedge. The right answer is objective is to protect the risk rising market price before the investment, and we are doing a long hedge. If you have any question, you can unmute and ask, because I may not able to read in real time your chat. Okay, so you can unmute and ask the question. Index future are primarily used to hedge which type of risk in the equity portfolio. So we discussed index future are used for the systematic risk. So systematic risk, which is inherent in the overall market, remains after diversification. So that is the risk is hedged with help of the index future. according to the expectation model, of future pricing, what does future price primarily represent? So expectation model suggests that what is expected future price? Okay, what is expected future price presently? What is expected spot price at end of the maturity? Okay, so expected spot price of the underlying asset on the future contract on an expiry. Suppose after example, Nifty future 3-month contract is 26,000 example. So expectation model says that current price is Nifty, let's say 25,100. But the model expect that after 3 months Nifty spot price, cash market price will be 26,000. That's the reason future price is showing the 26,000 today. This question we'll discuss. I'll open the Word file, okay, and we'll do some calculation so you will get more clarity. So Mr. A purchased 2 future contract, okay, very important word, 2 contract, okay, of XYZ Limited at 180 price, and lot size is how much? 2,000. What will be his profit or loss if he sells them at 187? Okay, so when position is open, okay, 2 future contract of 2,000 lot size, so total number of share is, okay, 4,000 and price is 180 example. So I'm just taking a time and showing the what could be a contract value. Okay, so 4,000 into 180, it is a 7,20,000 is the contract value. And if you can do it in the exam, you avoid the wrong answer. Otherwise, chances that we may miss out the word to future. Okay, we may miss out the some contract multiplier. So it is a 7.2 lakh position is opened when position is closed. Okay, so 4,000 into 187. Okay, and here we are open long position. We have buy, so it is a long position. So close, we are doing a short. Okay, so 4,000 into 187 contract value become a 7.48 lakh. So what is the profit? Profit is close minus open. Okay, so it is a 28,000 is the profit. We can calculate simply also 187 minus 187 rupees into 4,000, which is a 28,000 rupees profit. But I use little bit longer way to ensure that in exam you don't make a mistake, because in exam if you know the concepts and calculation, okay, you don't have a problem of time. Okay, sufficient time is there. Only is that if you make unnecessary hurry or you don't know the concept, then chances of wrong answer. So gain of 28,000. Next question, Mr. B. Again, I am so this is the question, Mr. B, short 5 contract, okay, of XYZ at 902 on last Thursday of the month expiry. Last traded price of August future is 912 and closing price in this cash or spot market is 910. What is the profit or loss if Mr. A, if position is squared up by the action? Very important keyword. Client has not squared up the position. It is done by the exchange. Okay, on expiry. So market lot size is 250. So in that, by using this information, if client reverse the position, close the position on before the expiry, even 1 minute before expiry, then the traded price was 912. But when Exchange, it is 910 because it is a last half an hour weighted average price. So client short the position. Okay. So client sell the contract at 902. On expiry, it is a 910. So there is a loss. Okay, 902 minus 910. So it is a 8 rupees loss per share. What is the number of contract 5? What is the multiplier? 250. Okay, so this is the total loss. If you calculate 250 into 5 into 8 equal to 10,000 rupees, loss is the right answer. Now, next question is, which of the following statement based differentiate open interest from trading volume in the future market? So, right, is the open interest is the total number of contract outstanding yet to be settled. Outstanding contract is the known as the open interest. Okay, now we have discussed also it is a one side we have to calculate. Okay, because when you add buy and long and short, then double. So basically, we think from action perspective, and only one side is considered. Okay, and while trading volume is measure the number of contract traded over the specific period, regardless of whether position open or closed. So it is a traded volume. Any question?
पहले क्वेश्चन में था
हाँ,
शॉर्ट किया
आपकी आवाज नहीं आ रही। Can आप थोड़े लिटिल बिट लाउड रहेंगे?
आवाज आ रही है सर अब
स्लो आ रही है बहुत।
भाई सर नहीं आ रही
ठीक है, विल टेक लेटर. Now using the Nifty example, उसको मैं so using the Nifty example, spot is 18,315.10 and May future is 18,345.50. What is the basis? So basis we have learned, it is a difference between the basis is a spot minus future. Okay, so spot price is 18,315.1 minus spot is future is 18,345.5. So difference, if you calculate 18,315.51 minus 17,345.5, so 18,000.
So it's 18,345.
Sorry, 18,000. So answer is equal to my mistake, writing mistake here. So it is a minus 30. So basis is negative minus 30.4. Okay. And what it suggests, so basis right now is negative minus 30.4 and converges to 0 at expiry. So it is always understood that this spot price will become a 18,345.50 on expiry. Okay, so that's the reason future price is on expiry, it will become a spot price. According to the again, let calculate. So according to the cost of the carry model described, share trading at 527, financing cost for that individual investor is 12% per annum, and dividend is expected 5 rupees. Okay. What now dividend is mentioned 5 rupees received. Okay, what would be the break-even future for the 2-month contract? So this dividend is expected to receive in 2-month period only. It is not mentioned per annum. Okay, so dividend is expected to be received. What would be the break-even for the price for 2-month contract? So this dividend is expected to be in 2-month period only. So 527 into 12%. So if you do a 527 into 0.12. So 63.24 is the for the annual, but now we want to do for a 2-month period. So first we'll divide by the 12. Okay, 63.24 divided by 12. So we got answer 5.27. So every month cost of carry is for interest is 5.27. Now we want to do a 2-month contract. Okay, so into 2 is equal to 10.54 is the interest cost. Minus what is dividend is expected, 5 rupees is expected dividend, so we'll remove from that. So what is the net cost of carry is 5.54. So 527 plus 5.54 is equal to 532.54 is the answer. So you have to select the nearest answer. Which is the nearest answer? 532.5. What determines the daily settlement price for the Nifty future? So we have already learned that it is a weighted average price of the future contract during the last half an hour. Daily mark to market settlement for Nifty future. Okay, for Nifty future MTM is T plus 1. Any question in the first test? If you have any question, you can unmute and ask.
सर इसका रिजल्ट आप मेल कर दोगे प्री और पोस्ट का रिजल्ट्स
हाँ, इस
रिजल्ट
सॉल्व करने के बाद मैं भेज दूंगा.
ओके थैंक यू.
हाँ, प्री ट्रेन टेस्ट अभी सॉल्व करेंगे और उसके बाद जो है मैं आपको शेयर कर दूंगा रिजल्ट.
So my question is regarding the last one.
हाँ बोलिए ना, बोलिए क्या क्वेश्चन है?
सर डेली सेटलमेंट जो होता है सर, that is on the same day, no? Or it's on a T plus 1 day for next day?
देखिए, डेली सेटलमेंट जो हम करते हैं तो सेटलमेंट जो है डेली उसका हुआ ट्रेड और सेटलमेंट होगा नेक्स्ट डे ना. आज समझो कि एमटीएम प्रॉफिट और लॉस हुआ तो डेबिट कब होगा? एक्सचेंज को जो शाम को पता चला, ओके, तो जो है डेबिट क्रेडिट जो है नेक्स्ट डे करते हैं आपके अकाउंट में.
ओके सर.
तो इसको हम कहते हैं T+1 ट्रेड प्लस 1 डे.
राइट, गॉट इट सर, गॉट इट. प्राइस मतलब लास्ट उसी दिन का रहेगा लेकिन सेटलमेंट नेक्स्ट डे होगा, ऐसा होगा?
यस 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 यस.
जी सर, जी सर.
सर मेरा एक क्वेश्चन था.
हाँ बोलिए ना.
सर कुछ सेशन मेरा मिस हो गया, तो ये पार्टनर टेस्ट पे अवेलेबल रहेगा ना रिकॉर्डेड सेशन?
यस, नेक्स्ट वीक में हम अपलोड कर देंगे सेशन को.
ओके, थैंक यू सर.
इंडेक्स हेजिंग का एक क्वेश्चन था. तो इंडेक्स हेजिंग में व्हाई इट इज कवर्ड ओनली सिस्टमैटिक रिस्क एंड व्हाई नॉट इट अनसिस्टमैटिक रिस्क आल्सो?
कैन यू रिपीट? आई डिडंट अंडरस्टूड.
एक क्वेश्चन था कि जिसमें हेजिंग के लिए इंडेक्स फ्यूचर को हम यूज कर रहे हैं, तो कौन सा रिस्क कवर कर रहा है इंडेक्स फ्यूचर? तो अपना आंसर था कि सिस्टमैटिक रिस्क कवर कर रहा है उसमें, ओनली सिस्टमैटिक रिस्क.
सपोज यू आर होल्डिंग द एग्जांपल Reliance Industry stock of 1 crore. Okay. Now Reliance Industry stock you would like to hedge with the Nifty future example. Now Reliance Industry stock has a two component of risk. First component is the market risk, which is called systemic risk, which is applicable to everyone. And second is the company specific or sector specific risk. So when you use the hedge your Reliance Industry stock with Nifty future example, okay, then what happened that you are not able to hedge the unsystematic risk. So to hedge the unsystematic risk, normally what people do, they use the stock future, okay, not the index future. तो जब आप इंडेक्स फ्यूचर स्टॉक फ्यूचर यूज करेंगे, रिलायंस इंडस्ट्री का मेरे पास 1 करोड़ का पोर्टफोलियो है तो रिलायंस का ही स्टॉक्स शॉर्ट करता हूं, तभी मेरा जो है अनसिस्टमेटिक एज वेल सिस्टमिक दोनों रिस्क वहां पे हेज हो जाएगा.
ओके, गॉट इट. थैंक यू.
ओके, तो हम आगे. हाँ बोलिए
सर. इसके लिए कोई बुक अवेलेबल है खाली जिसमें मल्टीपल चॉइस क्वेश्चंस दिए हैं 400 500 1000 प्रैक्टिस के लिए? तो वो
Yes,
प्रैक्टिस
it
कर
is
सके
required.
मतलब
देखिए
कोर्स पढ़ने के बाद।
नहीं नहीं, आपकी बात सही है। तो हम मैं आपको एक तो NISM की बुक जो है वो मैं आपको शेयर कर दूंगा आज या कल में, तो आप डाउनलोड करके वहां पे भी चैप्टर एंड पे क्वेश्चन रहेंगे, उसको सॉल्व कर सकते हैं।
वो तो
When
समय
you
में
do-
है, लेकिन इसमें 2-2 3-3 क्वेश्चन खाली दिए हुए हैं, बहुत
हाँ,
कम दिए हैं इस बार।
सेकंड I'll once session is complete, जब हम वीडियो अपलोड करेंगे तभी नेक्स्ट वीक में हम अप्रोक्सीमेटली 500 क्वेश्चन अपलोड करेंगे। अपार्ट फ्रॉम आपको लगता है ज्यादा क्वेश्चन करना है तो आप मार्केट में जो थर्ड पार्टी प्रोवाइडर रहते हैं, जैसे प्रेप काफे की आती है मॉक टेस्ट, या पासपोर्ट श्योर की आती है, तो वो आप सब्सक्राइब कर सकते हैं, उनका सब्सक्रिप्शन ले सकते हैं। तो बट प्लीज अंडरस्टैंड कि ये सब आप कब करेंगे जब आपके कॉन्सेप्ट क्लियर है, क्योंकि आप 100 क्वेश्चन करें पर कॉन्सेप्ट क्लियर नहीं है तो 101 क्वेश्चन आपका गलत हो सकता है, थियरी का
नहीं,
हो।
वो तो सही है सर, वो तो सही है, वो तो क्या प्रैक्टिस के लिए है।
यस
पर
कर
टीच
सकते हैं
करे
तो
तो अपन लोगों को हैबिट पड़े मतलब।
यस तो आप कर सकते एक्स्ट्रा ले के लिए मैंने कल ही बताया था, प्रेप काफे से आप ले सकते हैं
ओके,
इक्विटी या पासपोर्ट श्योर, जो भी आपको करंट लगता है विच यू कैन यूज।
राइट सर, राइट।
Okay, so now we are moving to the next and starting with the theory question है, तो so an investor hold a diversified stock portfolio 1 crore and planning to sell after 3 months for his daughter's education. He is worried about the short-term volatility and decide to short Nifty future for 1 crore. If market falls, how does hedge work and type of the hedge? So you are holding and you want to protect the downside risk. So it is called short hedge. Okay, and your risk is price reduction. Okay, you are worried about the falling the market price in next 3 months, and it is known as a short hedge. Airline wants to hedge the jet fuel price risk but finds no jet fuel future. Instead of hedge using the crude oil future, what type of hedge is this? So it is known as a cross hedge, because when you are using the different but relevant basically future, it is called the cross hedge. This is the question, so let's solve. So an investor holds a diversified equity portfolio worth 5 crore and portfolio beta is 1.2. An index future contract available at 25,000 and lot size is 50. How many long or short? So first we are holding, so you have to short the index future. And now how many index future we need to short? So first is we need to short the index future. So first we have to adjust the portfolio with the beta. Okay, so 5 crore into 1.2 is equal to 6 crore portfolio we need to sell. And second, here the 25,000 into 50, it is a 12.5 lakh is the contract. One contract size is 12.5. So when you do 6 divided by 0.125, so 48 contracts the investor need to short. So right answer is the short 48 contracts. If gold future trade below the current price, okay, gold future price is lower than the current price, okay, current spot price, what market condition does this signal? So we have learned, okay, this is known as a backwardation and indicate the expected price decline.
सर यहाँ पे मतलब रिवर्स कैरी क्यों नहीं कह सकते उसको?
नहीं, यहाँ पे ये पूछ रहा है कि इफ गोल्ड ट्रेड प्राइस बिलो द स्पॉट प्राइस व्हाट मार्केट कंडीशन डज दिस सिग्नल हियर। ये नहीं पूछ रहा है कि आपको कौन सा आर्बिट्राज करना है, तो ये बता रहा है कि क्या सिग्नल दिखा रहा है। तो ये बता रहा है कि पहले तो ये बैकवर्डेशन है और इंडिकेटिंग द एक्सपेक्टेड प्राइस डिक्लाइन। सो देयर इज नो क्वेश्चन इज आस्क्ड अबाउट द कि व्हाट काइंड ऑफ आर्बिट्राज यू कैन डू। इफ इट इज आस्क्ड देन यू कैन से कि यस दिस इज अ reverse cash and carry arbitrage opportunity. which of the following best describe the concept of convenience yield? Okay, so we discussed it is a non-monetary benefit. So it is a perceived non-monetary benefit or mental comfort gained by holding an asset during the period of scarcity, which is effectively reduce the cost of carry. Okay, so please understand, someone has asked during this session, I said we'll discuss later. So please understand that today we are living in metro. We have a space constraint also. We carry a example, keep grocery maybe on a weekly basis, example like US. But in earlier, people used to keep a grocery, especially wheat, rice, or basic pulse, maybe for 6 months or a year. Okay, so now definitely we don't expect any scarcity in our country. But if you are holding a stock of grocery for 6 months or 3 months, 6 months, so you are having a mental peace in case if there is a scarcity upon, if there is an unavailability of product. Okay, so that is the mental comfort. It is called convenience yield. Gold spot is 92,000 per 10 gram. So gold price is, spot price is 92,000 per 10 gram. Carrying cost for 3-month gold price is 1,500 per 10 gram, which is a cost of carry. So what could be the price? 93,500 is a fair price. But if gold future trade at 93,000, so gold future is trading at a undervalued. So you can do a which spot is sell and the future buy. So it is known as a reverse cost of carry. And again, basis is negative because basis is like a simply a spot price minus future price. So that is basis is negative, and this is the opportunity of reverse cost of carry. What scenario describe the calendar spread position? Okay, calendar spread means buying the same underlying near month contract. Buying means either you buy or sell same underlying near month contract. Okay, and opposite position in the mid month contract. Okay, so here long August gold future and short September gold future, so same underlying. Okay, short Reliance future contract with no option, it is a unhedged position. Long 3 Nifty future and short 5 Bank Nifty future. Okay, it's not calendar spread because one side is Nifty and second side is Bank Nifty. Buying 10 Infosys future and selling 10 Infosys future simultaneously, it is like a zero-sum game. Next question, let me copy. So question says, a trader sells one contract May Nifty future 18,275, lot size is 50. If contract closes at 18,345.5 same day, what is their MTM gain or loss and what is the revised position? Okay, so here it is a short position. Okay, so short position, so open here, short position 18,275. When close, it is 18,345.5. So this is a loss in the short position. How much it is loss? 18,275 minus 18,345.5. So here it is the 70.5 into 5, 50, because it is a one lot 50. So 35 minus 3525 is the loss. Okay, and what is the revised position value? So what is the new base price? It is the new base price will be 18,340.5. So loss 3525 and new position will be new base price. Okay, 18,345.5. How do future contracts primarily address the counterparty risk inherent in the forward contract? So we know that forward contracts have counterparty risk and how this problem is solved in the future contract through a clearing corporation that guarantees the settlement, reducing the default risk. Which is the following is considered major limitations of forward contract? What is the major limitation? So we know that risk of counterparty default and difficulty in liquidating tailor-made contracts. So if you want to close position before expiry, it is quite difficult. So any question here in the pre-trading test? Okay, let me share you the result. So I am releasing the score. So right now I have shared the pre-training test. Now I am sharing you post-training test. Okay, so you can review the paper after 6 o'clock. Right now, we need to discuss quickly the interest rate future and currency future contract reference to the examination. Only the differences will go through it. Concept will remain same. And then we'll also solve the one or two questions. So from here, we'll quickly read and then we'll solve the question. This question can be asked in the theory or information question. Theory or information question. So in India right now, the exchange traded future contract available, okay, for underlying USD INR, Euro INR, GBP INR, JPY INR. So these are the four currency contracts are available in exchange traded future. What is the unit size? One contract equal to 1000 US dollar. So one lot is equal to multiple of 1000 US dollar, 1000 euro, 1000 pound. But for Japanese yen, it is a 1 lakh yen. So this is the information you need to remember because sometimes this basic question may also come. For a Japanese INR, JPY INR, what is the contract multiplier? What is the contract multiplier? And you have a different option, 1000, 5000, 10,000, 1 lakh. So right answer is contract multiplier is 1000. Rates expressed in Indian rupee per unit. Okay. Trade price multiplied by the lot size. Tick size, here it is 0.0025. Okay, 0.25 paisa is the tick size. Okay, base price, theoretical price on a day one, thereafter daily settlement price. Price band, operating range plus or minus 3% for tenure up to 6 months. So contract with tenure, okay, 6 months. In currency contract, you have a up to 12-month future are available. So up to 6 months, operating range is plus or minus 3%. Okay, if price is 100 for pound, so example 103 and 97 is the range for the operating range for the contract price band, and plus or minus 5% for the longer tenure 6 months and above.
एक्सक्यूज मी सर
हाँ बोलिए
सर, जैसे ये प्लस माइनस 3 है तो इसका मतलब इसका भी जो मार्जिन लगता होगा वो प्लस माइनस 3 उतना ही होगा ना?
मार्जिन तो आपका इनिशियल मार्जिन जो है वो तो आपकी जो प्राइस पे आप एंटर होंगे उसका परसेंटेज में लगेगा ना. ये तो आपको प्राइस बैंड दिखा रहा है, और ये जो प्राइस बैंड है वो अप टू 6 मंथ का नहीं है. वो प्राइस बैंड है कि एवरी डे जो वॉलिडिटी आएगी वो वॉलिडिटी का परसेंटेज दिया है प्लस और माइनस 3% है. कि आज पाउंड में आपने कॉन्ट्रैक्ट एंटर किया, ओके 100 की प्राइस में, तो वो आज पूरे दिन में कितना उसकी प्राइस में वॉलिडिटी आ सकती है. तो 97 से लेके 103 की मैक्सिमम वॉलिडिटी आ सकती है, उससे आगे जा नहीं सकता है प्राइस. सो 3% इज दी डेली प्राइस वॉलिटिलिटी. स्टॉक में भी है ना 10% वॉलिटिलिटी, 20% वॉलिटिलिटी, डेली प्राइस वॉलिटिलिटी होती है। तो अप टू 6 मंथ कॉन्ट्रैक्ट के लिए डेली प्राइस वॉलिटिलिटी क्या है, 3% है, और लॉन्गर पीरियड के लिए अप टू 5%।
सॉरी सर, रिपीट कर रहा हूँ। जैसे आपने बोला था ना, उसमें निफ्टी में स्टॉक में भी 10% की लिमिट है उसकी, तो उसका जो इनिशियल मार्जिन है तो 10% के हिसाब से लेते हैं, तो अगर डिफॉल्ट हो जाएगा तो पूरा पूरा पैसा कट जाएगा उसमें से।
हाँ, तो इसीलिए करेंसी में कम रहता है ना, क्योंकि करेंसी का मार्जिन आपका 3% ही रहेगा अप्रोक्सीमेटली। आप जो लिमिट कम होगी तो आपका मार्जिन भी कम रहता है। अभी हम
ओके सर,
इनिशियल मार्जिन की बात ही नहीं कर रहे
ठीक
हैं।
है सर।
हम बात कर रहे हैं कि प्राइस बैंड क्या होगा। तो प्राइस बैंड समझो 3% है, तो नॉर्मली एक्शन विल आस्क यू योर इनिशियल मार्जिन इज 3% ओनली, बिकॉज एक्सचेंज को तो क्या रिस्क होता है कि इनकेस इफ देयर इज अ नेगेटिव 3% volatility and you lose your entire margin, okay, then they can recover from the initial margin.
सर ये जो डेटा है वो सिंपल क्वेश्चन आंसर्स के लिए हमें खाली याद रखना है ना?
यस, याद रखना है, ये क्वेश्चन आंसर के लिए याद रखना है, सिंपल। ओके, ऐसे ही हम आगे बढ़े क्विकली, टाइम लिमिटेड है तो उसका ट्रेडिंग टाइम भी याद रखना होगा। आ सकता है एग्जाम में, 9 to 5 है। ओके, एक्सपायरी वीकली भी रहती है, मंथली भी रहती है। ओके, वीकली है एवरी फ्राइडे 12:30 रहेगा, और मंथली है तो उसमें 2 वर्किंग डेज बिफोर द लास्ट बिजनेस डे ऑफ द एक्सपायरी मंथ ऑन द 12:30। ओके, तो मंथली जो है वो कॉन्ट्रैक्ट, सपोज जून मंथ का, फॉर जून मंथ कॉन्ट्रैक्ट, okay, the last trading day is that 2 days before the expiry, because settlement T+2 है यहाँ पे। तो लास्ट एक्सपायर जो होगा मंथली का, इट इज 2 वर्किंग डेज बिफोर द लास्ट बिजनेस डे ऑफ द एक्सपायरी मंथ एट 12:30। सेटलमेंट कैश सेटल्ड, तो इन इंडिया वी डोंट हैव अ डिलीवरी बेस्ड कॉन्ट्रैक्ट, इट इज कैश सेटल्ड ओनली। ओके, daily settlement price, volume weighted average price during the last 30 minutes, or theoretical value, final settlement, again the FBIL reference rate of the last trading day, MTM, and final settlement. So daily MTM is settled T+1 and final MTM settled at a T+2. So how you can do hedging example. So now I'll get it into the question. Okay, so you'll get a more clarity, so that our objective of learning is completed here. So now you will be able to understand the question. Mr. A sells USD INR 6 contract. So you know that one lot is equal to how many USD 1000 at a 85.2020. Okay. So now tell me one simple answer in a chat box. If someone selling the USD INR, okay, in future contract, so is that trader is bullish about the INR or bullish about the USD? I am saying that what is expecting bullish, I am bullish about the INR or bullish about the example, or you can say bearish about the INR or bearish about the USD. So please understand that when the trader sell the contract, so it is a selling the USD, because always it is sold a base currency. So when traders sell the USD INR contract, so he is shorting the $6,000. He is shorting the $6,000 at 85.2020. So it means that he is bearish about the USD, or you can say he is bullish about the INR. So now if tick size is 0.0025, how much he will gain if downward tick is 4? Okay, so now question is, he on a closing day, this price is reduced by 4 tick. Okay, so 4 tick means if you multiply 0.0025 0.0025 into 4, okay, so it is like a 0.01 rupee is down, so he is benefited with the, there is a profit for 6,000. How much profit? So 0.01 into 6,000 is equal to 60 rupees profit is there. So what is the profit here? 60 rupees profit. So question can ask, when downward tick is there, what is a profit, or upward tick? So you need to calculate the tick and multiply it, and you get the answer. Now this is the useful question. If Mr. A enters Mr. A enters USD INR future contract, okay, for September maturity of 100 lots on August 1. Okay, so you understand by contract. Okay, its data is missing. In exam, they will give you by contract. The future rate, Mr. A enters the buy USD INR contract for September 100 lots, August 1st. Future exchange rate is 86 per USD. He believes that spot rate for USD in 2 months would be 87.5 per USD. The margin requirement is 6%. If his expectation are correct, what is the annualized rate of return? Okay, so you can calculate it. Right now I'm just moving ahead with some relevant question. So here it is a profit. Suppose if you have to calculate the profit, what is the profit? 87.5 minus 86. Okay, so it is a 1.5 rupees per USD is the profit. Into 100 lot means 1 lakh USD. So it is a 1.5 lakh rupees profit is if spot price is after 1 month period is 87.5. This is also important question. An US importer has an exposure of 2 million in India market. Okay, now question is little different. An US importer has exposure of 2 million in India market. What should do? Completely hedge his position in US forex. Okay, forex market. Assuming 62,000 as a face value of one contract. Now imagine that it is a US company. US importer means US company which bought material from India, and they have to pay $2 million. How much they have to pay? $2 million. Okay, so when they have to pay means they basically short on the cash market because they have to pay. So what they are worried about that in case dollar depreciate against the Indian rupee, so they long the contract. First they will long the contract, and 62,500 is the contract value. So 2 million divided by 62,500 if you do, so they will long the 32 contracts. Okay, this is a question. On 3rd June, Mr. A sold June USD INR future contract at 85,200. So it means that one lot is short, 85.2 into 1,000. Okay, each USD INR future contract is for delivery of 1,000 USD. RBI reference rate for final settlement was 85.40. So on maturity, the price is 85.40. Okay, so definitely you shorted at 85.20. So now how it come 85,200 divided by 1,000, one lot. So it is 85.20 short. Okay, minus on a maturity it is 85.4. So it is a 0.20 is a loss. Okay, negative 20 into 1,000. Okay, so it means 0.2 into 1,000. So it is a 200 rupees loss. Loss in the future is the 200 rupees. So this is the example. Answer is given.
सर ये क्वेश्चन आंसर के साथ ही मिला ना आपने को शीट आप वही जो वो आंसर सॉल्व किया हुआ
I'll share you a comprehensive. Right now I have selected the only few question. Right now the question bank is construction. So once I'll construct, complete, we'll upload on the partner desk where there is a question and there is a solution is there. So approximately 100 question for the future and forward we'll prepare and share by the next weekend.
Okay, stepwise solution. Okay,
Yes. Okay, so one question is there, what is the outstanding position on initial margin will be charged for USD INR future? Okay, now open interest position question is there. Outstanding position means open interest. If no proprietary trading is done and detail of clients are, now you have to think from the exchange side, exchange point of view. One client sell the contract 85.50. Second client buy the 200 lot and sell the 400 lot. So now in a same day, client bought 200 lot at particular price and sell 400 lot, okay, at a higher price. Okay, so within the client netting can possible. Within the client netting is possible because what exactly happened? Okay, first he bought the 200 contract at 85.40 and then sell 400 contract at 85.50. So practically first 200 contract is basically close the position. So what is the client to open position is 200 short position. Okay, so in that condition, when I say for client 1, 110 contract is open, client 2 is 200. So total is how many? 310. So 310 into 1000 is equal to 31. How much it is? 3,10,000 is the open position. It is here. It is also calculated. Initial margin is chargeable on gross open position. So 110, 200 minus 400. So total is the 310 lot. So this is how open position is calculated. One more question will do it. So it will give more clarity. The open position USD INR future contract day 1 proprietary position is 2200. Okay, which is a short, and client X is 800 lot. Okay, which is a long, and client Y is 1800 long. On day 2, there has been no proprietary trade, but client A buys 1300 lot and sold 400 lot, and client B buys 500 lot and sold 700 lot. Find out the open position on trading end of the day 2. So first let's go with the first day. So first day it is a 200 proprietary short position plus client X 800 lot and client Y is 1800 lot. So everything is open position. So if you sum up the total 2200 plus 800 plus 1800. So first day was the 4800 was the open position. Now second day what happened? No proprietary trade is there. So here 2000. Sorry, same, no problem. So 2200 is the same will open. Client A buys 1300 lot and sold 400 lots. So what is the net for client A? Net client A, okay, which is the 900 lot. Client B buys 500 lot and sold. So client B, it is a 1200 lot. Okay. I think this question may not properly constructed because here client X is given. So something data mismatch is there. So let me get it into solution. Property position 200 short. Okay, then client XY date 2. Okay, so first day is perfect, 2200 plus 800 plus 900, what we discussed. Now here it is we have used client A and B. It is a X and Y only. Okay, let's say X and Y only is considered in the solution. So 1700.
फर्स्ट डे में सर सॉल्यूशन में फर्स्ट डे में गलत लिखा है.
So I'm ignoring this question right now. I'll discuss once I'll construct the proper question. Okay, I'll discuss tomorrow. We'll keep this question for tomorrow. Now, quickly in last 10 minutes, okay, I'll go to the interest rate future. In interest rate future also, we need to remember some key component. Okay, so cash settled interest rate future on government security, underlying single government of India bond. It could be maturity of 4 to 8, 8 to 11, 11 to 15 years. Year lot size is equal to face value of 2 lakh rupees. यानी कि 2000 bond multiple of 2000, contract multiplier is 2000, quotation face value 100, contract value is equal to trade price into 2000, tick size is 0.0025, price band is plus or minus 3%. Okay, trading are same 9 to 5, cycle 3 serial monthly, then 3 quarterly options. So total 6 options are there. Okay, 3 serial monthly and then 3 quarterly. Expiry last Thursday. Okay, mode cash settlement, daily settlement, same value, volume weighted average price last 30 minutes or theoretical price, final settlement price. Okay, and then MTM T+1. And second option is available, which is a 91-day T-bill future. Underlying is 91-day Government of India Treasury bill, unit trading, same 2000 units. Okay, quotation 100 minus discount yield, contract value 2000 into price, tick size same 0.0025, price band plus or minus 1%, trading hours 9 to 5, cycle same 3 serial monthly and 3 quarterly, expiry last Friday, daily settlement and final settlement. Okay, settlement mode is in cash. So quickly we'll discuss one or two questions, and I understand today we are discussing, in case if you have a question, we'll discuss tomorrow also. So let's take a one question here. For the interest rate future. So example question can be asked: an investor buys an interest rate future contract, 7 lot at 101.50 price. The contract size is 2 lakh rupees and get 2000 bond into 100 face value. If closing price is 101.80, what are the profit loss? So you bought a how many lot? 7 lot, and what price? 101.50. Okay. So when you sell, your selling price is 101.8 minus buy price is 101.5. So what is the profit on expiry? Okay, 0.3. How many contract multiplied 2000 and how many lot? 7. So when you multiply 0.3 into 14,000, okay, so it is a 4,200 profit when you either expire or when you square off the position. Second question: an investor buy an interest rate future 15 lot at 105.7 price. If contract size is 2000 bond, face value of 100. If closing price is 105.5. Okay, what is the profit or loss? So investor bought the contract at higher price and then closing price is lower. So it is an NTM loss. How much loss is there? It is a minus 0.2. into 15 into 2000. So my 0.2 into 15 into 2000 is equal to, it is a 6,000 rupees loss is there. Okay, so here any question, any query? So I understand we have a long learning session today where we discuss about the forwards and future. Okay, starting with the quickly with the important features and limitations, and then we move to the various next level discussion like the how future price is derived. Okay, how cost of carry, reverse cost of carry, and then calendar spread. And lastly, we solve the pre-training and post-training test. Okay, and as well as we have discussed the about the quickly the currency future contract underlying. Okay, as well as the interest rate and some of the question we have solved. And I'm sure that you go through the PPT. Okay, and in case if you have any query tomorrow, we can first discuss the question. Okay, PPT already I have shared in afternoon. Once again, I am sharing you. Okay, so you can download from the chat box. So this is the PPT I have. And I have already shared my number yesterday. In case if you have any specific query, definitely during the training period, you can ask during the training previous day query. But after training, if you have a specific query, you can write it into the below mail email ID. Even you can save my mobile number. Okay, you can send on a WhatsApp your query. I can reply you through WhatsApp if required. We can discuss it at mutually convenient time. Okay.
सर प्री पोस्ट रिजल्ट भी सेंड कर देना.
कर दिया ना, वो तो उसी समय कर दिया.
कर दिया.
हाँ, आप चेक कर लीजिए. प्री ट्रेनिंग टेस्ट और पोस्ट ट्रेनिंग टेस्ट के क्वेश्चन उसका स्कोर्स जो है रिलीज कर दिया है. अभी कोई स्पेसिफिक क्वेरीज है तो हम 5 मिनट डिस्कस कर सकते हैं. एंड देन विल कंटिन्यू टुमारो. कल हम सेम टाइम टुमारो कंटिन्यू करेंगे 2 बजे. फर्स्ट विल गो थ्रू दिस क्विक रिवीजन ऑफ द डे 2 as well as solve your queries, and then after we'll move to the interesting session which is the option. Okay, and how option can it's a 20% weightage in the examination, so very important session reference to the examination. अभी कोई queries है तो हम डिस्कस कर सकते हैं 2-3 मिनट के लिए.
सर वो लास्ट करेंसी का जो क्वेश्चन था उसमें वो 2 लाख रुपीस फेस वैल्यू का बॉन्ड का कोई मीनिंग ही नहीं है. वी जस्ट कैलकुलेटेड 2000 लॉट साइज जो है, तो 2 लाख फेस वैल्यू का क्या, व्हाई इज दैट? उसके पहले एक मार्जिन का भी क्वेश्चन था, 6% मार्जिन, वो ऐसे ही कैलकुलेट हो गया. आई डोंट नो व्हाई इट इज देयर, टू कंफ्यूज अस और व्हाट फॉर.
I'll just open and you'll let me know which specific.
लास्ट क्वेश्चन जो करेंसी का किया आपने,
लास्ट क्वेश्चन तो इंटरेस्ट रेट का
हाँ,
किया.
ये 2 लाख रुपए का कॉन्ट्रैक्ट साइज इज 2 लाख, तो ये 2 लाख किस चीज का है? मतलब
The contract size is always reference to the face value. Okay, so please understand price can be higher than that or lower than that. Okay, but it is given at information. Okay, contract size is 2 lakh rupees.
बट इट्स इररिलेवेंट टू आंसर एक्चुअली.
हाँ,
आंसर के लिए वो इररिलेवेंट है, वो 2 लाख का.
but when information, when question is given, chances that some information is not relevant for the question, it can be given to confuse you also.
हाँ, सो आई थिंक दिस इज ओके, फाइन. नहीं, थैंक यू. इसके पहले भी एक मार्जिन का था, 6% मार्जिन था, इंटरेस्ट रेट में आपने किया था एक, तो 6% मार्जिन करके भी उसमें आपने डाला था, बट आंसर में वो मार्जिन का हमने इग्नोर ही कर दिया उसमें.
हाँ, नहीं वहां पे एक सेकंड पहले ये तो सॉल्व हो गया ना.
हाँ, ये सॉल्व हो गया.
if this data is not given, समझो, so if you are not aware with the contract size, example, in some case if the examiner can give you information and don't give you about the contract multiplier. Okay, so what happened that if you are not aware the interest rate future multiplier, or if you cannot determine it is a multiple of 2000 example, then you may not able
They
to
have given
reach the
2000 ना,
right
2000
answer.
तो दिया था, they have given 2000 तो दिया था आपने इसमें।
नहीं, मैं ये बोल रहा हूँ कि क्वेश्चन में नहीं दिया है एग्जांपल, ये मैंने जो डिलीट कर दिया। An investor buys an interest rate future contract 15 lot 105.70. If closing price is 105.50, what is the profit or loss? So now I have eliminated the data of contract size example. So if you don't aware about, if you do not recollect that key in interest rate future contract multiplier is 2000, okay, then you may end up with the wrong answer.
Yeah, fine. Thank you so much. Thank
Okay,
you.
now what is the next question?
तो एक क्वेश्चन ऐसा ही था, इंटरेस्ट रेट के ऊपर था, आपने वहां पे 6% मार्जिन का आपने डाला हुआ था, आई थिंक
हमने उस समय वो पूरा क्वेश्चन नहीं किया था एक्चुअल टाइम की वजह से। ये क्वेश्चन ये कह रहा है कि
मार्जिन रिक्वायरमेंट इज 6%।
हाँ, सो ये क्वेश्चन अभी सॉल्व कर सकते, टाइम है तो यहाँ पे क्वेश्चन ये कह रहा है कि मिस्टर ए बाइज यूएसडी आईएनआर फ्यूचर कॉन्ट्रैक्ट 100 लॉट, ओके, at 86. So now you convert 100 lot into 86. So 86 into 100 into 1000 is the your multiplier. So it is 86 lakh. So what is the contract size is 86 lakh rupees is your contract value right now. Okay. For that, how much you are paying? 6% is the initial margin you are paying. Okay, so what is the 6%? 86 lakhs into 0.06 is
5,16,000.
0.06. It is a
20,000.
5,16,000 यार.
It is a 5.6 lakh.
5,16,000.
5,16,000 is the margin. So question says, I have not completed the time because I thought that we may have a lower time. So here it says that suppose if you invest 5.6 lakh, okay, and take a bet of contract value of 86, and your thought process that it will be 87.5 lakh, and you are right, let's say 87.5 into 100 into 1000 example, it's happened. So your value is how much? 87.5 lakh example. So how much you earn? Example, you earn 1.5 lakh rupees profit. So this is your profit on a when it is expired on maturity. So you earn 5.16 lakh profit on a you earn a 1.5 lakh rupees profit on a 5.16 lakh rupees investment. Okay, in a 2-month period. So you have to use the time value money calculator. Okay, and you have to calculate the annualized return. Okay.
नहीं.
Huh?
Yeah, perfect, sir. Thank you. I understood.
So sometime it is also called absolute return also. Okay, you calculate the absolute return. So it is easy where you can simply 1.5 lakh divided by 5.16. So you can say it is a 29% is the absolute return. But to calculate the that's your annualized return, you need to either use the Excel sheet and calculate the IRR, or you have a that specific calculator like Casio, and you can calculate. So
But can they ask this type of question?
Yes, it can be asked.
Okay.
Okay, sir. Thank you.
Okay, so thank you very much. See you all of you tomorrow evening same time, tomorrow afternoon same time, 2 o'clock.